Up next is an exciting keynote speaker session with Sarah Pearson, who's the Deputy Director General at the Department of Innovation and Tourism for Industry and Development for Queensland, and also on the Investment Committee at one of the most renowned venture groups in Australia, Main Sequence Ventures. Today, she's here to speak to us about the Queensland innovation scene. Welcome, Sarah.
Hi, my name is Dr. Sarah Pearson. I am the Deputy Director General of Innovation in the Queensland Government in Australia. And I have also many other hats. So one is I'm on the Investment Committee for Main Sequence Ventures, which I'm very proud of, the work that we do here in Australia to build deep tech industries and tech startups. Also on the Advisory Board for Impact Investment Exchange in Singapore, Advisory Board for the Space Agency, etc., etc. So I've got a few hats. But today I'm going to talk to you about the Queensland innovation scene, where we've been and what we're doing next. I'd like to start by firstly saying thank you so much for the invitation to speak to you, and thank you to those of you listening. I hope you find it useful and interesting. And I'd also like to acknowledge the traditional custodians of the land that I'm on right now and the lands that you are on, wherever you are when you're listening to this talk. I'd like to pay my respects to their elders past, present and emerging, and also acknowledge the tens of thousands of years during which they have been innovating and been incredible scientists as they have pushed forwards their own cultures. One classic example is that our Indigenous population here in Australia discovered the variable stars about 2,000 years before the Western world did. So we've got a lot to be proud of here in Australia for tens of thousands of years. So what are we up to in Queensland? One of the reasons I came to Queensland is because there's been a lot of work here happening for a couple of decades. It's not an overnight success. It's been about 20 years of investment and foresight and vision by the government and by the community, by the researchers and the entrepreneurs and investors. So it's been a long time coming. You've got here the vision that we have. The vision is basically to diversify the Queensland economy, as economies are trying to do all around the world, but also to make sure we're leveraging our competitive strength. So it's not just a pure, let's just do everything in innovation, but let's actually look at what we're really good at and what global competitive strengths we have. We want to drive sustainable economic growth and high value jobs. If you look at the predictions, 75% of future high growth jobs need STEM, science, technology, engineering and maths, and 65% of them don't exist. So we need to build these new industries or update current industries so they can be globally sustainable and competitive. Obviously, with all of this in mind, we want to make sure it's not just a vision, but we get some return on investment so that we get some outcomes and some impact from the work that we have been doing. And being a newbie to Queensland, I would say, I'd just like to say there is so much here that Queensland can be proud of. We've just been a little bit quiet about it, so I'm hoping that you can do something about that, and certainly today is part of that. Just a quick slide to look at some of the outcomes from this investment that's happened over, this one in particular is over the last 5 years. So we have a program called Advanced Queensland, and throughout that 5 years, or just over 5 years now, 755 million has been invested by the Queensland government into all sorts, a whole range of programs, from startups and schools, ecosystems, and also big business and small business. So a lot of work has been going on. We've been really thrilled that we found that has led to some jobs, a number of jobs, roughly 25,000 jobs over those 5 years have been generated. And obviously during COVID, that has become even more and more important as we're trying to recover from this and employ people. The other thing to be proud of is that the entities, the organisations, the companies that we've invested in have a much higher survival rate than the ones we have not invested in. So that means we are choosing companies that are sustainable and are growing sustainably. That 9 times number there is talking about our recipients are 9 times more likely to have a growth event than the people that we do not invest in. So again, that's showing that we're investing in high growth, sustainable companies that are generating jobs. The other thing to be proud of, 2 other things to be proud of. One is that 61% of the entities that we've invested in are actually in the regions. Queensland is quite unique in that it has our southeast Queensland area, so Brisbane in particular, which, as you can imagine, is a hotbed of innovation. There's lots of people that live here and quite densely. But then when you go out to the regions, there are also some incredible regional innovation ecosystems that have been growing and some incredible entrepreneurs in our regions that are growing businesses and jobs. So that's really exciting place to be from that perspective. And lastly, you cannot do this just with government money. In fact, I believe the government maybe has taken too much of a role here in Queensland, and we need to energise more of the ecosystem. I'll talk about that in a little bit. But you need to leverage other people's resources. That's not just money. It can be human resources or access to equipment, etc. And we estimate that we've leveraged 845 million of Australian dollars from partners within this program. So that's really good for us. If you look at things like the Sustainable Development Goals that are 2.5 trillion US dollars short of being able to be reached, your government realised quite a while ago that they could not help with the SDGs on their own. We needed to leverage other people's assets and resources too. So that flows through to a lot of what we do. So am I talking rubbish, or have we actually got some high growth industries here and some high value jobs in Queensland? Well, we absolutely have. Here's a few examples. Tritium. In 2016, the Business Development Fund, which was a sort of early stage VC fund that the Queensland government set up a while ago, they raised 2.5 million from that government fund, and it was matched by private sector investment as well. And that's generated over that time 194 new jobs. Clipchamp in 2020, in fact, the next three have all raised money in 2020, the challenging year for everybody. So Clipchamp raised 13.2 million, and that generated 80 jobs with that. Go One, this is like a Netflix for education, based in Logan in Queensland. We have invested through Advanced Queensland about 2 million in the past, but in 2020 they raised 62 million. So again, during COVID, they're still raising money, and overall they've raised about 120 million. They grew from 20 staff to 300 plus in less than 3 years. So they're rapid growth. Vaxxus in 2020, this is a vaccine delivery patch, so not using needles, but using a patch. $18 million of investment from Merck this year, and they grew over 50 jobs in 2020, and then more on the way. So this gives you an idea. There's some really high value jobs that are being generated in Queensland, and they're leveraging government money. Some other examples of some great companies we have here. So Safety Culture is our first unicorn, Queensland's first unicorn, and that was actually born within the regions. That was born up in Townsville. Online work health and safety tools, which is obviously going gangbusters, given that they're now a unicorn. Emergence is using drones in dangerous situations such as in mining, so underground mines, so going places where you don't want humans to go, using LiDAR. Tritium is an EV charging technology that now I think has got something like 70% of the market in Europe. I won't go through all of these. Movus is one that is using AI to understand whether you need to do some maintenance on your manufacturing equipment. Skyborne Technologies, this is drones used in defence. Black Sky Aerospace and Gilmore Space Technologies, two companies that are launching rockets right now, which is incredibly exciting for Queensland. Prevectus Algae, they're genetically modifying algae so that then they can use us as manufacturing plants for all sorts of chemicals. Swarm Farm, that's out in Emerald, so another regional piece. They've been developing robots for delivering chemicals in farms across large agricultural spaces, and they're saving farmers time and money, because they're using AI and imagery to make sure that they're only spraying the chemicals where they're absolutely needed, and they're saving lots of money for farmers. I particularly like that one because it's actually driven by farmers for farmers, so you've got the customer really understanding what's needed and delivering technology that farmers will use, to the point that they'll actually make stuff that farmers can mend, because farmers love tinkering and mending things. So I think that's a brilliant example. Vaxxus I've talked about. Fireball International are doing mapping and sensing where fires are, and we have had a bad season last year on that front. And FloodMap uses a lot of big data to actually map where floods will flow, so that you can tell people real time whether they should be getting out or getting ready for getting out. So a huge range of areas that are being born and growing and exporting globally here in Queensland. We also have a venture capital scene here in Queensland. So this page here has got a list of some of the ones that are actually national venture capital funds. So they're not born and bred in Queensland, but they're from a national perspective. And they're actually, but they're also investing here in Queensland. So Artesian Venture Partners, Main Sequence Ventures, as I think I mentioned, I'm on the investment committee for Main Sequence Ventures, and we're very proud of the entities that we have co-funded here in Queensland. Square Peg, Wholesale Investor, Brandon Capital, etc. You can read them yourselves, Blackbird Ventures, but these are national venture capitalists that are investing here in Queensland. But we also have some great venture capitalists and angels in Queensland who are building funds themselves. So again, you've got the words up there. We've got the Brisbane Angels, Pi Lab, Sprint, Greenspring, IQ Funds, Angel Loop, One Ventures, Black Sheep Capital, Cake, On Market, the C Venture Crowd, and Impact Queensland, and Transition Level Investments. These have all, a number of these have been going for some time, but some of them are also brand new, which is exciting to see the raises happening last year, end of last year and the beginning of this year. Really good that these companies are managing to raise money and invest money here in Queensland, for Queensland, by Queensland. What about government? So, in government, we've got various pipeline investment programs. So it's great that you've got venture capitalists and some angels, although I think we probably need to up the angel investment in the regions. But also government's got some funding that it helps to make sure we're getting that pipeline being developed. So Ignite Ideas Fund is one example, where we will give early stage ideas, including ideas in SMEs, $100,000 to $200,000, and that's really helping them to commercialise innovative products and services, and really helping them to grow and compete in global markets. But they're usually quite early stage. Then there's the Business Development Fund that I mentioned earlier. That has been an $80 million business development fund, and it's a matched funded early stage growth equity and they've invested in more than 60 innovative Queensland businesses, and I mentioned some of those earlier. The important piece here is that government can act as, in some senses, a de-risker in these investments. So we've certainly been hearing that from the ecosystem, that they would like government to help in terms of that de-risking side. The BDF is now subscribed, but there is talk about setting up a new one, but that's still in the wings and waiting for that. A new fund has been launched, or is about to be launched any day now, which is a $500 million Backing Queensland Business Investment Fund. And we have an entity called Queensland Investment Corporation, which is a managed fund that's all about promoting jobs. But they're starting to, they actually ran the BDF, but now they're going to start moving into also funding the later stage. So the BDF was it was Series A, and now the Backing Queensland Business Investment Fund will be the next level of growth, which is quite exciting for us. So if you've got the early stage grants, you've got the BDF, the next phase, and then you've got this Backing Queensland Business Investment Fund, it's looking quite good for our pipeline of investment. And then if you throw in the mix the other VC firms that are co-investing or even investing on their own, then that's really quite an exciting time here in Queensland. I was asked to talk about some of the emerging themes, and I think one of them which is really, really interesting. I mean, we've got emerging industries, which are ones you'd expect. So agri-tech, future food is a big one. If you think about all the sugarcane that we have in Queensland, sugarcane mixed with yeast gives you an amazing manufacturing plant for all sorts of chemicals and different foods and bits of food, so the ingredients for food. So I think that's a very, very exciting area for us. There's a lot of medical and health innovation here, which is really on the rise. Defence is another obvious one. A lot of defence innovation happening in Queensland, as well as the obviously ones like mining tech and resource tech here. One thing that you might be surprised at is from an artificial intelligence perspective, 60% of Australia's AI startups are actually based here in Queensland. So we're a bit of a hotbed for artificial intelligence, and that's spread across a whole load of different sectors. But what we've got here on this slide is the fact that the impact side of things is really on the rise in Queensland. So impact, the fund Impact, has actually just raised, I think it's about 30 million for their fund. And so this is going to be really great for stimulating even more investment and attraction of impact and support for impact startups here in Queensland. So it's really, really quite exciting what's going on in this space. There's also some interest from super funds. Now, for years now in Australia, we've been talking about the fact that we really need to get super funds involved in investing in early stage startups. And they've found that very challenging. There are some good examples of some that have been, but there's not as many as we would like there to be, given how much money is in super funds. But so we've been talking to some super funds here in Queensland who have a real emphasis on delivering value in Queensland. So the investors within those super funds, the employees that put their money into these super funds and their trust, would like to see some impact here in Queensland. So these super funds are looking for opportunities to do that. So we're at early stage discussions with them, and particularly around ESG and the SDGs as being thematics that they're very much interested in. They're thinking maybe a few of them could club together and then invest in a portfolio. It's too small bickies for super funds to invest in individual ideas, but investing in a whole portfolio is definitely of interest to them. And I know, Main Sequence Ventures, we collaborate with some super funds too in a really good way. So what are we trying to do this year? So last year was obviously really, really challenging with COVID. And so as a government and the money that we had, and the resources that we had, we were very much trying to help companies to survive through COVID. An example being, putting on programs to help entrepreneurs understand their finances. How do you make sure, if you're growing so rapidly, because you might be telepresence health or you might be online education or something like that, that if you're growing so rapidly, you know how to handle that and how to handle your money. Or it could be that your revenue is really drying up and you need to make your money last longer. Or it could be that you're going to go into hibernation, or it could be that you're going to shut down. So we've actually set up some programs to help startups with that, and got some really good feedback. Some of the startups were saying that they increased their runway by about 6 months, having gone through the program. So we've done some really good things that have worked well, including mental health for entrepreneurs. But anyway, going forwards, the amount of money is on the decrease. The amount of money that we've got available now, that's not good and good all at the same time. One of the things about not having much money is that it means everyone else has to jump in and do stuff together. And I'm a strong believer of ecosystems. I don't really call them innovation ecosystems or startup ecosystems. I like to call them new economy ecosystems. So this is how do we bring big business and small business, the research base and universities, the TAFEs, the schools, the entrepreneurs, the investors, government, and all the support infrastructure. How do we bring all of that together to help obviously build up startups, but also to help the commercialization of ideas coming out of universities, and how to help current industry to innovate so they can be globally competitive and sustainable. And of course, with COVID, we found that the supply chain, sovereign security around supply chains is meaning that we actually really want to be making sure we're building both new businesses to fit into those supply chains and also to help current industries pivot and change. And a lot of that is going to be around Industry 4.0, needing to become more efficient and effective. But that's all going to need an ecosystem. None of these ideas happen on their own. You need this whole community of people working together. As I think I said at the beginning, I also think that in Queensland, there's been a bit too much of an emphasis on government and a sort of government give us some money, the handout mentality. And we really need to move to a how do we all leverage and move and mobilize and connect our assets, sweat all the assets that we've got together to deliver some amazing opportunities from an innovation and a new economy perspective. So we're going to do a lot of work on that. The second one is around collaboration. So, there's quite often times when a few large corporates could come together with some universities and some entrepreneurs and investors and do something amazing. An example there is around agtech. So we have launched an agtech and logistics hub, and that's a collaboration between some corporations, agricultural corporations, as well as some technology corporations, and some universities. And so I think that collaborative piece is going to be really, really important as all countries end up having less and less money for this work. And lastly, inclusivity, and it's not supposed to be last, but it's just number 3 on my list here because I think it actually should be number 1. If you look at the unrest around the world, it's really, really important that we are inclusive and that we draw everybody in on this journey. Otherwise, we'll have the haves and the have-nots, and we'll have people coming out with pitchforks. So we obviously don't want that. We want to have peaceful and prosperous communities. So we're focusing on gender. So how do we help women join in this journey? First Nations, so our Indigenous population, but also bringing the whole population along. I mean, no one, I think, in Australia has done this well. We have left people behind. In fact, if you look at why it's not popular politically, it's because humans in our communities find the word innovation, the thought of innovation really frightening, and they're frightened that they will lose their jobs. How do we change that narrative? How do we draw people into this? As well as that could be drawing new investors into this space. So as I said, it involves whole ecosystems. So it's the usual, so the universities and the researchers, but we have to remember TAFE, our vocational education sector. I remember going to Boston and the mayor of Boston saying his biggest his biggest regret was that they let the vocational education sector drop, and they really needed all these great ideas coming out of Harvard and MIT, but none of them leading to businesses, scalable businesses, because they didn't have the vocational education piece there. Obviously, government has a role. We need to remember schools, the advisors and mentors, the startups, the investors, the corporations. And I think what often gets lost in these ecosystems is customers. We really need to draw them into this. And that could be corporate customers as well as consumers. But it needs to be holistic and connected. I've been involved in doing this for a number of years, traveled around the world and looked at and advised many of them. And in Australia, there's about 6 ecosystems, at least 6 ecosystems I can think of that I've either led or done the strategy for or helped in one way or another. And I'm really, really thrilled to see that really growing here in Australia, a number of great ecosystems across the country, as well as across Queensland. But at the end of the day, I just wanted to remind everybody what all of this is really about. It's actually really about people. And I think the downfall or the upwards trajectory of any of our new economies and new economy ecosystems is down to humans, it's down to people. And in my experience, the things that stop this from working are silos and cliques and people who won't get on with other people and this concept of what's in it for me rather than what's in it for us and how do we give. And I think that's something that we can really, really build on here in Queensland and in Australia. What is it that we're all giving? What's the big, hairy, audacious goal that we're all going for and we can all get excited about together so that we can actually build these new economies? So we have, if you want to join in and connect, we have this thing called the QI Hub. And on there, we've got lots of innovators and startups and supporters. So if you want to join that community and get engaged, perhaps mentor, perhaps invest, perhaps look for money or look for people to be in your company, please jump on and see how you can use that community. It's an online community we specifically developed during COVID because it was hard to have face-to-face. And lastly, I just love this slide because I love the picture. Ask your kids what business they will start or grow. It could be a new business or it could be a current business that really needs to grow and change, or what impact they want to have using innovation, not necessarily what job they'll do. So thank you so much for listening. And as I said, feel free to connect through our QI Hub or reach out at any time to me. Thank you very much.
Presenting next is Shebah, Australia's leading all-woman rideshare. Here to talk further about this opportunity is CEO and founder George McEncrow.
Hi, I'm George McEncrow, the CEO and founder of Shebah. What is Shebah? Shebah is an all-female rideshare app specifically designed for the safe transport of women and children. Here are some of the key metrics that you will need to know about before you invest in us. We launched in March 2017. To date, we have grossed over $10 million. And yep, we haven't been alive 4 years yet. So we also have over 253,000 riders. We've had a 7% growth rate, excluding COVID, but that wasn't a good time for anybody. We have well over 100 B2B clients. We are a purpose-built IT platform designed through the lens of women and kids. We are a very trusted Australian brand. And of course, our technology was built here at home in Australia. Some of the figures you're going to see here, or all the figures here, are based on an Australian market. So please bear that in mind. So who is Shebah? That's us. We are first and only all-female rideshare. We operate Australia-wide with an international launch planned, and we are very excited about moving into New Zealand. We are licensed and approved to move there. We have a highly sophisticated tech platform, again, native build, and we are totally compliant nationally. Of course, with federation, different states and territories, that is not an easy thing to do these days, because at one point rideshare was just anyone could have a crack. Now it's a very highly regulated sector. So the problem that we are trying to solve might be obvious to some of you, may not be. A lot of women have felt very unsafe in taxis, in cabs, in Ubers, because it's like being in a very confined space with somebody you don't know. There's a lot of information that gets sent to women about where to sit, not to have drunk too much alcohol, not to travel at certain times of days and nights. And we quite frankly think that's outrageous. It's a waste of opportunity. And a lot of the businesses that have come to us to use our platform agree. They would like to see their staff out and about, enjoying life. And a lot of families love the use of our on-demand use of our car seats as well. So 1 in 3 Australian women experience violence, sexual harassment and so on, don't feel safe, don't feel certain, don't feel comfortable, feel like they're being locked in a car with a man they don't know. And this affects both the drivers and the riders. We want to bring more women into this sector as drivers as well. So Shebah has exemptions in every state and territory to offer this all-women rideshare service. As drivers, we're a specialist service, so we offer our drivers a very good rate of return of 85% commission. We offer a working with children checks. They have to have a working with children check. So all our riders know that their child, you can't put a minor in an Uber or any other rideshare service, but a lot of families have done that unknowingly. Only at Shebah can you put a minor in one of our cars because we've got those working with children checks. All our car seats have been expertly and professionally installed. So you know that they've been fitted by an expert. They are safe. If you want to get on a plane and get out at the other end without carrying your own car seat, that's a wonderful thing. We have a preferred driver feature, which is really helpful for families too. You can do school drop-off, same driver, same person every time. We also cover pets, split fare, all of those things. 25% of our drivers are also shareholders, which is a wonderful thing. So here are the opportunities for drivers to become workers. They can enjoy a great sense of community. Mums, they can travel with their bubs if they want to, as long as they tell their rider. We have a lot of retirees, empty nesters looking to top up their super. It's a great opportunity. These are our target market for future drivers. Recruiting drivers has been the expensive part of this business, and certainly something that this investment will go towards. So Shebah is a very trusted brand. For the reasons we've stated, we have very highly vetted drivers and we are in demand. We have an endless supply of businesses, schools, hospitals, those services coming to us saying we are the only solution to this problem, and they want to use our drivers and we want our drivers to be part of this solution as well. So yes, there are other people doing an on-demand service, but they're not a Shebah driver. And Shebah has the skills, the reputation, and just the assets to be able to service this very big part of the sector. So this is the size of the opportunity. The B2C alone, 10 million households in Australia, 12.6 million women, 4.7 million children that currently do not have a rideshare service, 5 million families where both parents are working. We do a lot of that schlepping around between mum and dad, picking kids up from school, taking them to sport, before school, after school. 3.9 million women over 65 who are wishing to top up their super. We have a lot of workplaces approaching us wanting to get safe transport for various people for various reasons, especially aged care facilities, wanting to use our services, a lot of banks, law firms, architectural firms, places where people put in long hours and they want their staff to be getting home very safely and comfortably. So we are unique and we are in the market built for women and kids. Here's the competitive landscape. Obviously everybody knows about Uber, Ola, DD, SheSafe. Well, you might look this up. They've not started, but they were going to. And then there's taxis. Interestingly, women are only 6% of cab drivers and fewer than 10% of Uber drivers. And that's because it feels unsafe to be an Uber driver because you can't control who's getting into your car. The risk is shared between both driver and rider. Our growth to date, so pre-COVID trip numbers were projected to continue at 7%. Therefore, greater than 36 trips were predicted in Q2 of 2020, compared to the 10,000 actual trips were completed due to COVID-19. But this is the trajectory we were on. And this is what happened. So the monthly trip histories by dates and times. Yep, ouch, COVID. But here is what happened with our rider acquisition, which is interesting. Drivers dropped off because, yes, you have to pay some money, and there were people who were on JobKeeper and so on. But the rider numbers continued. We stopped all spend on rider acquisition, and yet we continued to grow riders. Our targets coming up, we really have a very strong vision to continue on our trajectory. We're currently doing 400 trips a day. We will be doing 500 by June very easily. The marketing will be directed towards new driver acquisition, but that also has a very large technical component as well. We have license to expand in New Zealand, reduce customer wait times, and form more partnerships in the industry. We have a very experienced board of governance and a great team here at Shebah. You can read more about them. And the capital raise, we're seeking to raise $5 million, and this is to get us to IPO in 12 to 18 months. And the key turning points really will be doing 15% decline rate, a lower than 15% decline rate, and increase drivers across the platform to meet demand. The technology is the biggest investment, tech and marketing, but operationally, we also need to fill out the tech side, hiring more people. That's key. And we anticipate that to be in 12 to 18 months. And here are some of the untapped opportunities: increased opportunity to grow in New Zealand, all those countries mentioned there, corporate partnerships, allied services, and some vertical integrations, which we have not tapped just yet. You can have a read at your leisure. Wanted to meet you myself. I'm Georgia McEncrow, the founder and CEO. Welcome to Shebah.
Presenting now is Nano Nutrients, an Australian bionutraceuticals company focused on researching and developing chemical-free botanical nano and water-soluble wellness innovations for use in consumer products. Here to talk further about this opportunity is founder and CEO, Philip Ferguson.
Hello, thanks for joining our presentation. My name's Phil Ferguson and I'm the CEO and co-founder of Nano Nutrients. We're new frontier botanical innovators, particularly around nano technologies and water solubility. So Nano Nutrients, we're an Australian bioceuticals company and we're focused on developing nano and water-soluble wellness innovations. Nano Nutrients was born out of sincere desire to help people by making only the best high-quality bioavailable wellness products. We've successfully developed new frontier nano technologies that enable vitamins and botanical extracts to be able to mix with water to produce liquids, powders and gels. We've developed a portfolio of products that encompass these technologies that offer the market-leading health solutions. So you'll see here the phase 1 products that we've spent the last 24 months developing. We've got 12 there and we're ready to launch in the States in June. Our headline products are the nano curcumin and the raw CBDA hemp. So nanoparticles, it explains here why it's so important. It's particularly around absorption, therefore bioavailability. Any particles that are too big just simply pass through the GI tract and are passed out the other end as waste. So all our products, we have proprietary processing techniques that reduce the particle size to maximise absorption. You can see down the bottom left there the benefits of curcumin, a very well studied organic compound. Our 2 proprietary technologies are clean curcumin and nanofluidic, and we've also got Cryotex and Biophos. So we've been able to get curcumin without the use of solvents down to 20 nanometers, which is the world's smallest naturally processed curcumin. And there's just a huge spike in bioavailability. And we've encompassed this technology in our nano curcumin water-soluble liquid product. And you'll see regular curcumin there on the bottom slide there, the left, unable to be stirred in, quite hydrophobic. And ours on the left there, stirred in, and you'll see particle size analysis there on the graph as well, from regular curcumin, 10,000 nanometers, to our clean curcumin down to 20 nanometers. Okay, we've got a vertically integrated equity partner over in Cape Town, quite a renowned, well-respected nutraceuticals company that will be doing our manufacturing. They're FDA, TGA, GMP approved. They've got high-grade laboratories there with particle analysis, high-volume manufacturing. So yeah, it's a great partnership, and one of our directors resides in Cape Town and is very good. Has a very close relationship with the owner of this facility. So yeah, they've invested in our company, and we look forward to a strong, robust relationship with them. Product release phase. So we've got numerous products developed all the way through from those 12 that I showed on the slide before, all the way down to pet products, which we've got a gel that we developed for pets. So it'll be flavoured in a way that your cat or dog will just lick it off, whatever you put it on your hand or on top of their food, particularly for muscle support. Like I said before, the raw hemp and nano curcumin are our two big products, which will be very high volume when they're marketed effectively. You'll see the launch dates there, USA first, followed by EU, UK, Australian launch soon after. So we are at execution stage. We are ready to launch in the States in June. Clinical trial. So part of the money, 100K in fact, of the money raised will be used to just dig a little bit deeper. We want our own data on nano curcumin. There's data out there already, but we want our own data. Same with the deep, calm and skinny for our clinical trials, our own data, our own marketing. Raw hemp. This is a big one. So yes, CBDA is a precursor to CBD. It's been studied. It's very potent. It has a lot of benefits over CBD. It's certainly got an exciting future ahead. It is a new frontier in cannabinoid, extract. Huge global market for CBD products. 123 billion by 2027. So huge growth ahead. IP, we've got a provisional patenting for clean curcumin. With money raised, we'll close that patent off and expand it globally. Same with our trademarks as well. So this is the team here. So we've got myself, Phil Ferguson, Dan Schultz, very experienced. He's our Chief Science Officer and co-founder. He also is a consultant to North America's largest cannabinoid distributor, ECS Brands. Tian Stewart, he's a very experienced marketer and also ex-hemp wholesaler. Very, very knowledgeable. He resides in South Africa, and we've got Dr. David Rudd as our advisor and shareholder, and he's a research fellow at the Melbourne Centre for Nanofabrication and also holds a position at Monash University. So the reason for this offer, it's there. It's for expansion globally, USA first, Australia, EU. We want to increase our inventory holdings, patents, clinical trials, boosting our IT and other costs associated there. Substantial money has already been spent by the founders to get to this stage. A cash boost to expand globally. Okay, well, thank you very much for viewing this presentation. And if you do have any questions, please feel free to contact me and I'll be happy to answer them. Thank you.
Presenting now is rentrabbit.com.au, Australia's first and only website giving insights into experiences of renters and rental properties. Here to talk further about this opportunity is co-founder Ben Priddy.
Hi, my name is Ben Priddy, and I am co-founder of Australian PropTech startup rentrabbit.com.au. We're a fast-growing, highly scalable Australian PropTech startup. Our experienced board of advisors have been involved in companies such as CoreLogic, RP Data, and Harcourts. We are looking for seed investment of $500,000 with a minimum investment starting at $50,000. It's common knowledge that you can't trust images on a rental listing. But what if you had a trusted community of renters sharing their collective experience? rentrabbit.com.au is pioneering the divide between knowing and guessing when it comes to rental properties. rentrabbit.com.au is Australia's first and only website giving insight into the experience of renters at rental properties. Renters today are relying upon one-size-fits-all information, published and controlled from the perspective of the landlord or agent. This results in inaccurate and gapped housing data, making it harder to find the right property the first time, a time-consuming renter search and viewing experience, uneasy pricing negotiations for the renter, rental agreements with a high probability of breaking down. Built on the foundation of increasing rental transparency and communication, rentrabbit.com.au combines previous rental experience, real photos, landlord and agent ratings, and actual expenses with traditional listing information. All this information is shared by those who know best, the previous tenants. In turn, renters on rentrabbit.com.au save time, are well researched, and more informed about future rental properties before they step foot in the door. This is why thousands of Australian renters are turning to rentrabbit.com.au to help them find the perfect home the first time. rentrabbit.com.au boasts a pre- and post-lease search advantage, where users leave reviews upon exiting a lease. The advantage of combining qualitative and quantitative data allows us to present this to future tenants easily and simplistically. And of course, we learn as our users input their preferences, making rental matchmaking smarter and faster. Our software has been uniquely designed according to decades of knowledge and industry insight. The learning and patentable component of our software allows our technology to grow as renters leave more reviews. RentRabbit's biggest strength comes in the form of a like-minded community, working together to better their collective experience. Building this community via social media platforms is a core objective. Gen Z and millennials are content, review, and engagement driven. 80% expect personalised content and experiences. 2 in 3 read online reviews before making a decision. Current real estate platforms do not provide property history, content, and comparisons relevant to the renter. Without these aspects, user stickiness is compromised. The current real estate approach is out of date with the younger generation. What are the biggest motivators for people to leave reviews? Those posting reviews are often motivated to do so because they want to help others and reinforce the independency of the review ecosystem. 90% do it to help others make good decisions, 86% to share their own experiences. rentrabbit.com.au boasts an unparalleled market and landscape understanding through the strength of our advisors. Our unique and sole positioning in the market as a renter-focused platform delivering user-generated content provides first mover advantage. The accumulation of this unique user-driven content platform, combined with our swift data acquisition strategy, means we will remain unmatched for the foreseeable future, protecting the business. rentrabbit.com.au's revenue model is underpinned by service-based referrals, sponsorship, and advertising, reaching $26 million in revenue and 80% EBITDA by June 2025. User growth will drive transacting customers, which will attribute $21 million in revenue by year 5. Our traction to date is highlighted by a $200,000 raise, 2,000 pre-registered users, and a CPA 7 times greater than traditional real estate. We are also in talks with 6 home service related providers. Here we see our timeline, which has been met with our soft launch in February and our hard launch and a further raise commencing in March. We have a solid team with an impeccable track record. Our company boasts senior advisors with extensive experience in the information technology and property data industries. So what are we asking for? rentrabbit.com.au is launching a $500,000 seed round in exchange for 12% equity. The valuation is at $3 million based on a combination of traction to date, forecasted earnings, and a successful soft launch. I know you're interested, so why don't you contact me via the Brella platform now.
Rivershop is a vertically integrated retail, property, technology and investment management group focused on delivering superior investment returns for all stakeholders by merging physical and digital retail, hospitality and experience platforms. Here to talk about this further is Director of Funds Rodney Tim and Executive Co-founder Patrick Halkalka.
I'm Rodney Tim, Director of Property and Fund Management at the Panthera Group. This group was started by Shaquille Kamal and Maria Evangelo, who had a shared passion for development, retail, hospitality, and technology. And we use our skills, our track record, and customer knowledge to create unique in mixed-use precincts and technology solutions.
I'm Patrick Halkalka, the Investment Manager and Executive Co-founder of Rivershop.
The Panthera Group is different. We invest in property. We've got shopping centres, mixed-use assets, and we create precincts using our unique offering and industry disruption strategies in order to curate enhanced customer journeys and experiences. But we also do hospitality. We've got our own brands, and we partner with other major hospitality brands to create food and beverage outlets that are different in unique and iconic venues. This adds investment value by delivering convenient hospitality experiences to our customers. But in addition, we've got our technology group. We create cutting-edge retail technology overlays for the physical retail infrastructure. This captures online shopper loyalty, revenues, and data to inform our tenants and for our promotions. This adds value, obviously, for the retailers, but also for us as property investors and for our partners, both in terms of growth of sales as well as revenues. The problem with shopping centres in this digital age is that the smaller and moms and pops retailers, the lifeblood of the retail and hospitality offerings, don't have the time, the understanding, or the capital to compete in the digital and omni-channel retail world. At the same time, we have independent ordering and delivery apps, the menu logs, the DoorDash and the Uber Eats, who cannibalize retailer margins, taking up to 30-35% of their margins. And their objectives are not aligned to those of the physical retailer, landlord, and shopping centre owner. So we've come up with Rivershop.
Rivershop is a bespoke omni-channel retail ecosystem made for retail property owners and their merchants. It allows them to trade in a physical and a digital environment and capture the surrounding trade area. The vision for Rivershop is based on 2 key pillars: connected commerce and connected engagement. Connected commerce is about giving a digital fit out to the physical retailers and merchants in a shopping center or retail property. We also are able to provide the e-commerce businesses an easy path to physical retail with digital display hubs, logistics support in the physical locations. Enabling multi-merchant soon on the platform will also enable us to allow customers, the end customers, to purchase multiple products from multiple merchants in one transaction, in one order. Connected engagement is all about supercharging the local community. It is about allowing the local merchant to trade with the customers and the customers to avail their services easily. It also enables them to communicate with the local merchants via the community pages and the merchant loyalty systems.
So there are benefits for both the retailer merchants as well as the owner landlords. For the retailers, there's multiple sales channels, the apps, the website to support their physical presence. There's comprehensive merchant portal with digital fit out and onboarding, which we assist in. There's click and delivery, click and collect, and drive-through functionality. And they can have on-demand or scheduled ordering and booking options. But also we support their food and beverage and small retail inventory. For the owners and landlords, we can create exclusive geofence precincts with precinct-level branding. We align with the retailers and we provide comprehensive admin and support in the portal. There's precinct and merchant-level marketing, promotions, and loyalty functions in the app. But the most important is we capture shopper data and we can analyze this to really drive targeted trade area promotions. This obviously enhances revenue generation in line with occupancy costs for the retailers and the centre MAT growth.
The overview of Rivershop. Rivershop is essentially a custom-made, tailored, omni-channel marketplace for retail property and its asset owners. It helps the local merchants penetrate the local trade area and provide them digital services. We'll soon be adding multi-merchant online ordering system, which will allow people to buy from multiple merchants in one transaction. Omni-channel fulfillment options, which are already active, such as click and collect, click and delivery, drive-through, and ship from store. We also manage our own last-mile delivery services, making it an absolute breeze for merchants who come online and deliver via Rivershop. Web and kiosk and apps allow customers to easily engage with the platform, whether in the physical location or via a mobile device or a desktop device. Plug-and-play showrooms provide a unique offering to online retailers who want to join the brick-and-mortar environment and expand their customer base into new markets. Online appointment bookings allow service providers to now provide their offering in a digital platform and have a more committed trade. Rich customer data captured and analytics for both the property owners and the merchants allows our platform to provide a unique service. This is a very quick overview of the functionality that is either existing or coming soon to Rivershop. Rivershop already has the ability to ship from store or our digital hub, click and collect in our shopping centers and retail properties, allow drive-through services, and multi-merchant online checkout, which will be added soon, will allow ordering from multiple merchants and multiple product types, F&B click and delivery, retail click and delivery, and online bookings, which allows majority of the offerings in a shopping center to be provided online. Merchant system integrations allows us to easily integrate with most merchant POS and payment systems. Marketing and loyalty program allows us to easily and digitally engage with customers both online and in the shopping centers. And store wayfinding coming soon will allow customers to find our merchants easily. This is a quick app overview of what the app looks like on mobile devices. The app is available on Google Play Store and on the Apple Store. This is what the website looks like on desktop and tablets. The customer journey of Rivershop is very simple and is very familiar to most customers. It essentially allows the customer to browse the list of products available on our merchants' stores and add that items to their cart and pay for them in the checkout. They can then track the progress of the order and provide comments to the merchant and the delivery partner. Each merchant and delivery partner can then view these metrics in their own data and analytics dashboards.
So our current milestones, we've been working on Rivershop since 2018. We've run various pilot programs at some of our centres. The current version of the Rivershop app was approved in March 2020, both on the Apple Store as well as Google Play. Rivershop was first deployed in this version in Maitland in April 2020, and over the next 6 months, we saw significant growth in orders, merchants, and customer sign-up. We've now also deployed in Raymond Terrace in October 2020 with a similar growth trajectory. Our future plans is to increase the sales support by the addition of service merchants, the bookings, which we're in process of doing at the moment, as well as light retail inventory, baker, butcher, pharmacy, etc., which is also a work in progress. The additional functionality or partner integration that we're working on at the moment is wayfinding, loyalty programs, and multi-merchant policy. What we'd like to do next also is to activate landlord partner. And this is incentives both similar to ours or in regional areas. This app won't just be used on our shopping centres. We're happy to partner with other retailers, shopping centre owners. We activate our increased service footprint across New South Wales and Australia, and then integrate into the Mall of the Future, which we'll talk about in a moment. So what is our competitive advantage? We own shopping centres, we understand shopping centres, and we understand how technology can be an enabler in order to support our retailers. We have aligned objectives in the omni-channel retail platform, both from the physical precinct as well as through to the digital apps. We focus in regional areas where there's less competing independent service providers like the Uber Eats, etc. And we empower the smaller and the moms and pops retailers. We've got this unique ability to facilitate food and beverage and small retail ordering and booking services via delivery, click and collect, and drive-through. Rivershop is designed to increase MAT at the centre and asset value for the centre owner by empowering localised, aligned e-commerce or gig economy supported retailers. Rivershop's got an exciting future. It is but one cornerstone module of the Mall of the Future app that we're in the process of developing. This is an ecosystem and integrated shopping centre data hub. It's been envisaged as the ecosystem that powers omni-channel shopping in shopping centres with an integrated data hub with multiple data-rich touchpoints. Mall of the Future is at various stages of development in the modules. Some of them have been developed internally and some of them by partnering with best-of-breed functionalities. So this is a good opportunity for an angel investor. We're inviting angel investors to open discussion and potentially become a co-investor with the co-founder as an early backer. Panthera Group is seeking $2 million to invest in the Rivershop platform, specifically created to service retailers in alignment with property asset owners. The ideal investor profile from our perspective is early stage investors that have retail or technology experience, ideally both, and have an understanding of the current retail and e-commerce trends and the desire to disrupt. Or investors with an exposure to retail property who see the need for customized solutions for retail property owners to align with the digital future of their tenants.
We thank you for viewing the presentation and look forward to having you on a long journey and a successful journey at Rivershop. Thank you.
Presenting now is Arc Network, a fast, mobile-based PropTech platform developed for project marketing professionals and property developers. Here to talk further about this opportunity is Phil Foraker.
Hello, I'm Phil Foraker and I'm partner of Arc Network. We are a PropTech and Fintech business where we help developers, house and land builders, real estate agents and finance brokers save time, save money and build wealth through our platform. What I'm going to show you now is a quick video demonstration of our live product that is on the market now and we have paying subscribers. So as you can see from the video here is the app can be downloaded from the Apple Store and Google Store. It provides information and tools to help agents on the ground promote and provide information to the client live. As you can see here, is you can see we've got the VR, we've got the floor plans. It's a full tool that powerhouses the agents on the ground. Like the communication we're saying is it's an agency in a pocket. You could run your whole business from your phone, anywhere, anytime, and get information to your client instantly. It's all in the palm of your hand and in your pocket. So the app itself as well is a CRM. It provides communication tools to the client. If you are a large business with agents on the ground or multiple salespeople, this tool can also track their performance, their activity, but at the same time, like any business, we want to track and forecast the sales that are coming through. The key power here is the power of getting the sale across and information consistent across the board. But why do we do it? Why did we build ARC? We know ourselves that we've built it. The reason being is we found ourselves personally, myself being in industry for over 20 years, is that when a property goes to market, there are so many different channels, but those channels have different types of platforms and networks. So what happens there is there's miscommunication and loss of money because of the opportunity costs that are lost. ARC is coming in to streamline that process. We want to help increase the sales, but also decrease the time it gets to that sale. It was developed to help agents on the ground with the evolution of the way the market's moving now. With COVID coming in, everyone was doing things remotely, couldn't have opening houses, inspections. So we've developed the tools to help get the client in the home, but not being in the home. We also adapt and sync with other CRM platforms like Salesforce, HubSpot, Zapier. We are a full system that talks to other systems to give our users the peace of mind. And at the moment, our business is generating income from monthly subscriptions. The market here in Australia is huge, and we're going through another cycle right now, and it's increasing. But the benefit here is, how do we capture that? How do we capture that information soon and get it out there? Well, ARC is that tool, and the feedback we get from our users is it's actually helping them increase their sales and increasing their revenue. Our business model, it'll keep it very simple, is we have different ranges and different platforms. So our minimum is $299 a month to up to $2,000 a month, which is like our enterprise agreement. We make additional revenue by providing virtual reality resources to help developers close deals on off-the-plan projects. And we also make commissions on the property through our specialized zero deposit program. At the moment, when you look at our target, we actually have over 700 users with over 90% actively engaging in our app. What I'm showing you today is more the front end, because we have a big back end system here that is a very powerful tool, but I just don't have time to go through it today. With over 700 users, giving you an example, we may have one account with over 20 agents, and they'll be able to oversee and see those agents, their activity, what they're doing, forecasting their sales, with over 700 and growing daily. So at the moment, we're actually on track to hit our targets. The big thing about our business is it's been word of mouth. We have not spent any marketing money at all. We have gone to market through our existing channels and existing networks, and what we have found is referrals. We are getting referrals that are coming in pretty much on a daily basis, and that is great. But imagine if we had the additional support, and that's why we're asking you to help to invest and get some equity in business, if we could take it to that next level. Our monthly revenue is actually exceeding what's projecting here. So I'm very excited about that and would love to have a chat to you if you would like to invest in our business, further information on how that would work. So the ARC ecosystem. So let's go through the ARC ecosystem. ARC Agent is the app to download, which is the front end, but it's the full tool. We also have this available as a web version, and the web version also shows a full back-end system, which is more designed for the senior hierarchy, the admin guys. When the sales guys are on the ground making sales, that's what they do. Virtual reality now, this is a key here. So later on, once this video gets preloaded, you come back to me my video and scan the QR codes. And the reason for that is we did a VR for a developer who was struggling to sell property because people didn't have a vision of what it would look like. It was just empty ground. People are visual. So what we done was we built the virtual reality, and 2 years later, we did a VR video of the live. And when you look at the two together, we are pretty much spot on, and I'm very proud of that. That information, our team did a very good job. And especially in COVID now, we're actually getting more and more work where people now want to build virtual reality because it's cheaper than building a display home. The cost, you're talking about $1 million cost there for a home builder to do display, to house or to pay staff. When if you do it virtually and digitally, and we can do it through ARC and help increase sales, improves in performance, improves the distribution of their product. Equity Mate. So Equity Mate is one of our exclusive unique products where we help clients get into a property with zero to little deposit. Our recent testimonial video, and you can have a look, and there's testimonial videos out there, we helped a 22-year-old get into their first home with zero deposit. Now that's exciting. How was that sales done? It was all done through ARC. We had an agent who had a client who didn't have a deposit. They looked at the zero deposit products that were available. Then the agent communicates to the finance broker who's on ARC. So it's all, everyone's talking together. And then we had the finance broker engaging with our lender who's also using ARC. So what we do is I have the whole chain and process through the ARC system, through the ARC network ecosystem. And we are improving that. And that's on the back end. We have many, many clients. As I said, we're growing strongly with many testimonials. We are very competitive in the market. We believe there's nothing like what we do. Because why? Because we found personally what we need as a business, and that's why we developed it. And we want to share that because we believe that this is a strong tool that can be used. But it's not us, because it's our users. Our users are using these tools. We actually have Queensland's largest property club on our system using it for all the agents across Australia. So having key groups using our platform is an endorsement for us. Our pricing, as I said, is very competitive because we want to make it affordable. And let's talk about our team. Now, our founding members, we've got William, we're based here in Australia, and we've got Henry. So we do have a support team and an office over in China. I also want to mention that ARC has been self-funded for the past 2 years. So all funded, self-funded by the partners. Our leadership team as well, we've got Winston, who looks after our products. You've got myself, and then we have Tracy, who is our VR and support specialist. And we also have a support team as well here in our Australian offices. So before I recap and finish off, what we are seeking is we are in the process of doing a $1 million capital raise. Right now, we're just over 60% of funds already invested. So if you'd like further information on an investment opportunity that has growth and also national presence, please have a chat. We'd love to have a chat to you about the opportunities here. And further, if you want further information on how our back-end process works, I would look forward to speaking to you soon. I'm Phil from ARC, and thank you for your time.
Up next is Senator for New South Wales, Andrew Bragg, who will join us for a unique Q&A session on the importance of technological innovation and the framework for research in Australia.
Hello there, I'm with Senator Andrew Bragg, a Liberal Senator from New South Wales. Senator Bragg, thanks for joining the conference.
John, how are you?
Now, early in your senatorial career, you became the chair of the Fintech and RegTech Committee.
Yeah.
What does that committee mean to you, and were you surprised to get it so early in politics?
Well, I think it's important that when you have an opportunity to represent the people of New South Wales, as I do in this case, that you spend that time wisely. And I sought a reference from the Treasurer, Josh Frydenberg, so that we could do an investigation into the myriad fintech and regtech issues. So far, I think it's been able to yield quite a lot of useful policy development.
Yeah, and we'll get to that. But This area is really important to you, isn't it? You're quite passionate about it.
Well, I mean, I'm interested in financial services. I spent a lot of my career before being in Parliament in that sector, and I do see the technology and the finance components of our economy is very important to our country's future. Lots of employment, lots of opportunities, and for an economy like ours, which is a relatively high wage, with a good society and a high level of sort of public services provided, we have a lot to offer the world.
Let's have a look at the hearings and the Senate committee in two halves. You spent a little longer in the first half than you planned to because of COVID and delivered an interim report. So what did the first phase of the committee produce for you?
There's two purposes to this inquiry. The first is to find ways to establish more Australian jobs, and the second part is to create more opportunities for people to choose different services. So jobs and choice, those are the two things. And that is, the foundation of all the policy in this space. And so in the first phase of the review, we went through and we identified barnacles on the ship, problems, barriers which were holding back new investment and the capacity to bring new people into the country, which I think is a key driver of are you going to win more jobs in this jurisdiction? And then we also did some deep dives into things like buy now, pay later, which I think has been quite an interesting area.
Senator, you spoke recently about the importance of technology innovation when it comes to Australia being competitive on the global stage. I think this audience would love you to expand a little on that.
Well, I mean, my view is we have a great opportunity to capture the growth that will fall out of Hong Kong. There is enormous geopolitical change in our region. I think a lot of it is quite unsophisticated. I mean, Hong Kong will still be an important gateway to China, but it won't be the same regional financial centre or regional tech centre because people just won't want to be in danger of the national security law. But equally, we must compete with Singapore, with Tokyo to win that business. It won't just come to Sydney or Melbourne. And so that is a real challenge for us. And so in order to win that business, we need to have a system where capital and the best brains want to be in our country. And there are many things which hold us back. I mean, people like to compare us to Singapore, especially in this tech space, fintech space. We have very different systems, both democracies, but our democracy is a messier, noisier democracy. And we love that, right? We defend that. But it means it's harder to get changes through which will drive more capital and better people into your country. We have more rigid labour laws. We have more rigid tax laws. We have more complex tax laws. And so I think it's very important that we have an agenda. And we now have, I think, quite a clear agenda in Canberra to try and win the best brains and to win that capital from jurisdictions like Hong Kong. Because we have demonstrated the capability in technology. I mean, fintech is something that we're very, very good at. And you've seen companies like Canva, Afterpay, Zip, Safety Culture, which have all become unicorns. So we're good at this. We're exporting that expertise across the world now, but there's so much more we can do. And I think as the economy transitions, technology is an endless opportunity for Australia.
You've partially answered my next question, but does Australia have the right economic framework for R&D in particular, R&D investments from the research stage to fully commercialisation?
Yeah. Look, there's been a lot of feedback to our committee about the R&D tax incentive, and it is, I believe, quite a rigid formula, and it hasn't been drafted with software in mind. Now, software is a major opportunity for Australia. And so we made recommendations in the interim report to try and improve the operation of that scheme. We're still working through those, and we may need to revisit that in the second phase. I mean, taxation is a big thing, right? I mean, the way you tax, your rates of taxation, how competitive you are compared to other jurisdictions is all very important. I mean, if you think about Japan, it's an interesting, for people who are thinking about investing in Australia or in Japan, I mean, 10 years ago, if you were a female founder or you were a female in financial services, Tokyo, I think, probably for many reasons, not that attractive. But I think under the changes that Shinzo Abe made to corporate governance and culture in Japan, I think Japan is now a much more viable competitor to Australia. And so we have to be careful that we continue to update our systems. We're never going to compete on headline tax rates. Our company tax rate is the second highest in the OECD and probably the highest in Asia, actually. So we need to make sure we have tax schemes which incentivise investment, recognising that our government has spent so much capital trying to cut the company tax rate, and we have failed for large companies. We have a lower tax rate for small companies, but schemes like the R&D tax incentive, I think, are very important that they are competitive.
Well, now that you've spoken about tax, you are at this conference in your capacity as a legislator. What can new companies expect from the government to assist them in their ventures?
Well, we have a lower 25% tax rate for small companies with turnovers of less than $50 million. And beyond that, we don't really have a whole lot to offer, to be honest, because we don't have the sort of tax deals that you see in other jurisdictions. But one of the things I have commissioned in my role as a parliamentarian is this Australia as a Financial and Tech Centre agenda, which is chaired by Andrew Lowe. And this particular report recommends that we could have an incremental tax rate for companies that bring parts of their business to Australia from offshore for a limited time. And so that is effectively a tax deal. So I could say to you, okay, if you're going to bring that investment and that growth and those jobs to Australia, instead of Tokyo or Singapore, I'm going to cut you a tax deal. So I think, we should have the capacity to make tax deals for certain periods of time. On the personal tax side, we're very uncompetitive. Again, we have very high personal marginal tax rates. And so I think for temporary residents, people who are genuinely global citizens, like temporary residents under our tax system, we could have a different system where you could have a days in, days out model for taxation. So there are options on the table that we could consider as a government, and I am expressing a view that we should adopt these policies.
Yes, indeed. It was very enterprising of you to put this advisory group together. Some real heavy hitters in Australian business came together and made some recommendations. Which of those recommendations are you going to take to Josh Frydenberg's door?
Well, the AFTAG report, which is what it's called, it's an interesting grouping because it's not just big business, it's also small business. So you've got the CEO of Bright, and you've got the CEO of JP Morgan. So you've got a smaller player and a bigger player on that committee. And I think that's important to show that a founder like Kath McConnell, who set up Bright, can influence public policy. I worry that the founders don't have enough of a say on our policy settings in Canberra because they're not organised in the way that big established industries are. And for example, the big banks or the big miners have got a seat at the table much more easily than a smaller group of founders. And my party, the Liberal Party, was created for, frankly, people that aren't organised, like organised labour or organised big companies. And so I wanted to give a voice to, founders and smaller companies as part of this process. And there is a good networking effect that happens in, I think, the tech sphere. There is a genuine interest to help the next generation get up to scale and get moving, which I guess is the reverse of the ladder. When you hear about people who get to the pyramid and then they pull the ladder up underneath them or after them. So that's good. So I wanted to harness that. But I think in terms of the key recommendations, they're really around how do we get talent into the country? The global talent scheme is important. I think there's a lot of support for that, but maybe some tweaks there. And then the big dogs here are taxation. So could we have a more flexible tax system, one that could accommodate a days in, days out system for individuals, so that you could bring in the best minds to do a job and then they could go back? And also, what can we do to attract business units here from places like Hong Kong now? So making investment decisions and foreign investment clearance easier, and also reward them with a tax deal if they're going to bring their business to our country. So those are a couple of things I think we should do in the here and now. but also we've got to make sure that in terms of investment, that we are doing everything we can to incentivise that. And so we recommended in the AFTAG report, just as we did in the Fintech report, that there should be a broader range of investment vehicles. So we should have more options than just the unit trust. There should be a corporate CIV, collective investment vehicle. There should be a limited partnership CIV. And also, we shouldn't have barnacles like interest withholding tax on all the transactions which apply when none of our competitors do this. So we've got to make sure that we're always painting, to use a very Australian expression, that we're painting a bridge, we're painting the harbour bridge with our tax and our labour laws, so that we always have this external disposition that we're watching what they're doing in Tokyo, we're watching what they're doing in Singapore, and we're improving our own tax system, and we're improving our own ability to attract labour, the best people. Because, Sydney Meyer, who set up the Meyer Emporium in Bendigo and then Melbourne, and Frank Lowy, who set up Westfield, these people are people that could have been lost to New York or California or Toronto, but we got them in Australia at the time. We want to make sure that we're getting these people into Australia now. Jack Zhang, who set up Airwallex, which is another unicorn, who's in Melbourne, he's a great example, right? Of someone who's set up his business here, who's employing hundreds of people in Australia, but doesn't have to be here.
Senator, it seems to me that what you've said about your advisory committee and their work dovetails a lot with phase 2 of your Fintech inquiry. Would it be fair to say that? And is that the direction you're going to take the inquiry in?
Look, I think that's right. And as this is a conference for founders and enterprising people, I wanted to have more than just one touch point, because I think a lot of people would say, look, we're just not configured or resourced to deal with a parliamentary committee. We don't know what a parliamentary committee is. I have to say I struggle with it myself. It is very confusing. And so I wanted to make sure that there were multiple touch points so that people could get in touch through this network of 12 people who are on the AFTAG committee in order to get the feedback from the market. Because in technology and finance, we're a long way behind as institutions. The market moves so quickly, and the policy making that happens in Australia, especially in a noisy, boisterous, wonderful democracy, it does lag behind. So we need to get faster, but you can't get faster unless you know what the market intelligence is, what's happening out there. And so that's why I thought it was appropriate to have some parallel processes. And I'm a new person, I'm a relatively young person, I'm keen to try different things. So if people have particular ideas, they should get in touch directly with us at senator.bragg@aph.gov.au so we can get the fresh information from the market. Democracy only works if people feel as if that they're connected to it, right? And so I don't want people to feel they need to fly or drive to Canberra, give a piece of paper to influence the policy making process. We're there to work. We're there in Canberra to work for the people. And so I like to be as accessible as I can be.
Finally, Senator, are there any initiatives on the horizon coming from the public sector that you see that you feel that entrepreneurs will benefit from or could benefit from?
From the public side?
Yes.
Well, I think we have a lot of different schemes where we're seeking to help the private sector, but the solution here is not government doling out grants. The solution is how can government make the enterprising environment as enterprising as possible? And I see that as really making sure that you have world-class tax laws in terms of your tax rate and your complexity or lack of complexity. You've got labour schemes which allow you to bring the best brains into our country. And you've got a level of dynamism in your system where your labour laws, for example, aren't being a drag on your capacity to grow a business. So those are the macro things. And then there is also the need to deploy specific policy measures into things like payments and technology sectors, which is an endless thread of things. But I think by focusing on the fundamentals, that will drive your success as a nation. And I have to say, we have done well in this fintech environment. We've got a lot of unicorns here. We're employing a lot of people. We're exporting our expertise offshore. Yes, we use Uber on our phone from California, but people in California are using Afterpay and Zip, so that's a good sign. So it's a good start, but more to do.
Senator, it's been a pleasure to have you at the conference. Thank you for joining us. We appreciate it.
All the best.
Presenting now is GMG, Graphene Manufacturing Group, a clean technology company that has developed and provided its own proprietary production process to manufacture graphene powder from readily available low-cost feedstock. Here to talk about this further is CEO Craig Nicol.
Hello everyone, I'm Craig Nicol, CEO, Managing Director and Founder of Graphene Manufacturing Group. GMG is a clean tech manufacturing company that takes graphene made from natural gas and uses it to sell into two largest energy markets of energy savings and energy storage products. We're currently going through a qualifying transaction with Cuspers Capital on the Toronto Stock Exchange Ventures. And this should complete with us being on the Toronto Stock Exchange Ventures in around middle to end of March. We've also just opened and now closed the sub-receipts additional raise of $2 million Canadian. This was only open for a bit over a week with existing and new investors oversubscribing more than double, which will give us another $2 million and should give us a close to $5 million when we are listed in the Toronto Stock Exchange in less than a month. What graphene is a wonder product with many different applications, and it's often now being caught up in the ESG theme and certainly in investment space as well. Graphene has many, many different applications. The main applications that we focus on are in energy storage, in batteries, energy efficiency, and also in energy emission savings in fuels and lubricants. As you'd all know, our energy storage is a massive emissions reducing parameter, but also energy efficiencies is seen as, in fact, a bigger emissions reduction opportunity by the IEA. Both represented significant reductions in emissions in 2018. The target markets for GMG are near $150 billion per annum global sales. The addressable market size is broken up into four distinct markets: the graphene powder, which is emerging, the air conditioning efficiency coating, which is close to $26 billion, the engine oil fuel and efficiency additive, which is around $14 billion, and energy storage devices, which is around $108 billion in 2020. GMG makes its graphene from natural gas with some electricity, and then the other byproduct we have is hydrogen. As compared to our competitors who take graphite and mine it and crush it, and often through some chemical processing, get their graphene a few atoms high carbon. That, though, has often some constraints around it and has some variability in definition. Our graphene there can be seen on the black side of the picture, and our competitor's graphene oxide is there seen in grey. Just in the sheer clarity of our colour, you can see the high quality of our graphene. And this was being tested by a number of different universities, including the Graphene Hub at University of Adelaide, which show we have outperforming existing graphene on the market. We have currently 4 products in the market. We have our graphene powders for composites and battery additives, which we've sold to various people around the world. And we also have our liquid graphene products. One is what's called Thermal XR, which is an energy-saving air conditioning coating system. And the second one is a lubricant additive. The Thermal XR, which is the air conditioning coating system with our graphene, can enable some large energy saving and emission savings on air conditioning systems. G lubricant is a concentrate that we make in a lubricant form, which we then sell and provide to lubricant manufacturers around the world to be able to reduce their friction over the existing engine oil and also increase wear resistance. It has been found, our graphene has been found to save emissions by reducing the amount of fuel used. G-lubricant is a concentrate which we mix and then show to our lubricant manufacturing customers their ability to reduce wear and reduce friction, which is then in turn proposed to also reduce their customers' fuel bills. We have a number of lubricant blenders who are currently working with us, going through a process of how to use this in their own products, and we expect commercialization this year. We're also targeting near and medium-term revenue in various different types of batteries. We have been selling a graphene to lithium iron phosphate manufacturers in Asia, as well as we have other companies who are doing lithium sulfur batteries, which is the next generation. But the most interesting battery opportunity that GMG has is an aluminium ion battery, which I'll talk about shortly, which is a next generation battery, which is also extremely environmentally friendly and high performance. Potassium ion and sodium ion batteries are also being developed with QUT and University of Queensland. The University of Queensland developed aluminium ion battery is enabling a battery which will have 3 times the energy density of the current best lithium ion in the market, plus also have up to 60 times faster charging. The team is largely ex-Shell, including myself. I spent 21 years with Shell. The chair of the board was before he left Shell after 37 years, was the executive vice president for strategy portfolio. He helped the board and the CEO move to hydrogen and battery space, where Shell seems to be leading that space globally out of all the oil and gas companies. The CFO, executive director, and other directors are certainly very well experienced in a small cap to mid cap market. We have my head of technology is a very close friend of mine over 20 years with enormous amount of process engineering experience, and we have world leading graphene knowledge from our head product scientist. The other team are specialists who've been doing their work for some years now and are able to come in and add value immediately. The team is ready to expand with the systems being built. We have a company-wide CRM system and as well as multiple other systems and processes documented, and we're rolling more of those out as we speak. We have an oil and gas background focused on hearts and minds, very focused on safety and the environmental management and stewardship of the process. The team is also ready to expand. Our IP is self-developed and owned. We're using both a combination of patents, downstream patents, and trade secrets. Our production capacity is scalable in a multi-unit train approach. Our product costs are very low, consisting mainly of gas and electricity when looking at main direct costs. And our quality repeatability is very consistent and controllable, and we review and manage that weekly. We have systems in 6 business processes implemented, and we're implementing more as we go, including on top of our CRM system, which is already up and running. We have an oil and gas hearts and minds background with respect to safety and environment. So in summary, we're a world-leading clean tech company, global graphene technology, applications and manufacturing capability. We have superior product over graphite graphene, low material cost, proven production process, which we own through a trade secret. And then, happy to take any questions on Brella.
Presenting now is Cipherpoint. Cipherpoint protects enterprises' most sensitive assets, being employee, customer, supplier, and business data through machine learning and AI. Here to talk about this further is Chairman Ted Pretty.
Thank you for allowing me to present at this W&I Investor Conference. Cipherpoint is already known to many investors on this platform, as we're presented on our core business, which is around data security, particularly for SharePoint environments. The company is listed on the ASX. It's a micro-cap stock. Our ticker is CPT, and I encourage potential investors to look at all of our filings over the recent months and last 2 years. Cipherpoint is a software business, selling software or licensing it to large enterprises to protect the privacy of their data. We've decided to expand the business and to look for acquisitions, and we've recently announced that we will be acquiring a managed security service provider, Brace 168. I'd like to take you through what that acquisition entails and the opportunity it presents potentially to interested investors. Before I start off, this presentation was lodged on the stock exchange on the 8th of February this year as part of our announcement of the transaction and as part of outlining how we would fund and finance the transaction. The usual investor disclaimer is shown on your screen, but it's also referenced in the ASX lodged document. So the acquisition summary is pretty straightforward. We're acquiring Brace 168 for a certain amount of cash, 2 million in cash, and shares in Cipherpoint. There is a deferred cash components and further tranches of shares based upon Brace achieving certain revenue milestones in FY21 of $3 million per year and FY22 of $5 million a year. So these revenue streams are largely recurring revenue based. The interesting thing about the transaction is that we're funding the acquisition, the initial cash component, from our own cash reserves, but raising further funding to expand the business and also to continue to expand our core software business. The transaction is subject to certain shareholder approvals and achieving certain funding milestones. I'm pleased to advise that we've already raised the necessary cash as part of the funding milestones to ensure that the transaction does go ahead subject to shareholder approval. The transaction highlights are important to note. This business is, as I've said, a managed security services business. It has solid clients, recurring revenue, and it positions CPT or Cipherpoint for growth. The team at Brace is highly competent and moreover has unique intellectual property in the way that it manages security for customer environments and networks. We see the opportunity as one of growth. So Brace 168 is poised to move and increase its revenues based on our performance targets almost threefold between FY20 and 21, and again doubling roughly in FY22. Now, there's no guarantee that these milestones will be met, but our due diligence gives us confidence that the company is on the right trajectory. What's the transaction investment rationale? Security is a high-growth industry in IT and networks. So we still see a lot of growth available, not only in the Australian market, but offshore. And indeed, Brace has amongst its customers those which have security requirements in the US and in Europe. As many of you may recall, Cipherpoint already has an office and presence in Germany. So we look forward to being able to assess the potential for this business to expand into the European marketplace. It has a specific cybersecurity focused, and if you look at other comparable companies in the Australian market, you will see a reference here to Tesserent or TNT on the ASX, or Arctis or AR9 on the ASX, and we consider that we've got a very strong cyber specific focus and we've got an innovative platform from which to grow. One of the interesting things of the transaction is how we're going to fund it. As I mentioned, the initial transaction has been funded by cash reserves. We have also raised further funding for growth, and we're conducting a pro rata rights issue or entitlement offer to all of our shareholders. Now, of course, those who do not take up their allocation, other existing shareholders may wish to participate and can indicate that in the subscription, but the board has reserved the right to place any shortfall subsequent to the close of the rights issue to interested, sophisticated investors. And you'll see in the pack it contains details of the sources and uses of the funding that we are making use of. Let me give you a little bit of context of the cybersecurity industry and an overview. It's a bit like healthcare. It's going to be there constantly. You're going to constantly need to upgrade not only your network security and your platform and system security, but also the security you specifically wrap around your data. So if someone does penetrate your network by compromising, for example, user credentials, there'll be another layer of security that is actually protecting and encrypting the data as it sits at rest in your organisation. So we see the Brace acquisition in terms of network and environment security as highly complementary to the security that Cipherpoint has traditionally offered around the data itself. There are many companies in this space, but not many that integrate the service offering as we intend to do. The market opportunity is clear. Cybersecurity is one of Australia's most promising growth sectors. The numbers here are big, but the potential in our specific market sector, particularly in the Australian environment, is strong. And that's why you've seen a lot of activity in this sector over the last few years. Australia also has a competitive advantage given the services-dominated economy, low sovereign risk, and therefore and good education systems that make customers confident in using our services as opposed to services from other geographic jurisdictions. So post-merger, we're going to have a business that has software elements in our protection and data protection software, also our data discovery software, and also offering managed security services. So we'll have a complete service offering across a number of markets, which you can review in the pack. We've outlined the team structure, which gives you a sense of how our business will be organised post this acquisition. And at the end of the day, we believe that the history of Brace being established in 2017 and growing quite quickly will actually create a good growth engine for Cipherpoint. I'm not going to go through all of the other slides in the pack that deal with how the Brace managed detection and response system works. I'll leave that for investors, or potential investors may actually come to us. And finally, there are good customer testimonials from Brace which encourage us in relation to this acquisition. Finally, I'd like to thank investors for their interest. Please contact us if you'd like to learn more about Cipherpoint and about the acquisition we're about to make. Thank you.
Presenting now is CV Laser, a Perth-based biotech company which has significant strengths in the areas of research and development, as well as commercialization of medical technology. Here to talk further about this opportunity is CEO and Executive Director, Dr. Mukesh Jain.
My name is Dr. Mukesh Jain, and I'm the CEO of CV Laser. And the CV Laser is an Australian-based company and advanced developed the solid-state laser ablation technology for the purpose of correcting refractive errors of the eye. So the CV Laser developed the technology which is the latest next generation laser for ablation of the cornea for correcting the refractive error of the eye. We have used this laser in the last 10 years in 45 locations in 18 countries and tried 200,000 patients worldwide. And we are looking to roll over this laser worldwide now. So the history of the company is that we developed the laser between 2001 and 2010. And from 2010 and 2020, we tested the laser worldwide. And in 2020 and 22, we are trying to roll over into the Asian and Middle East market. 2022 to 2023, we are planning to roll over into the Europe, Latin American market, and 23 onwards in the US and the world market. So we invested about $50 million in the development and the clinical trials of the laser. We are looking $2 million in the equity, and which will offer 16.66% of the company equity. We are planning to have a FDA IPO in 2023, 2024, and that can be the exit plan for the people who are investing at the moment. The money which we are planning to raise, which will go to design a new laser, the ISA 300Z, which is based on Pulsar Z1 science and the technical trials, setting up the manufacturing unit in India, getting the TGA and CE mark, and roll over the production in Australia or in Europe and in China FDA trial. So basically, the laser we are developing is a unique solid-state laser, which is going to replace the toxic gas-based laser, which is dominating in the world market. At the moment, the market is moving away from the gas laser in any industry, industrial, medical, any industry. It's a communication everywhere. The gas laser is a history. So every industry is going for the solid-state laser, which because it offers the better outcome, the better result, and the long service, the long life of the laser. So the laser, first of all, we have Australian patents on this laser, and the new model, which has a faster scanner, the latest workstation, and we are planning to make a very robust laser, which we can offer a 15 years working assurance to the client, which will be a very profitable to any clinical hospital and clinics and the hospitals. So that can give you a very brief comparison of our competitors, who are very big companies in the world, and they have changed. If you see the slide, they have changed the hands and have an acquisition. So the main features is we are offering nearly 3 times the life of the excimer laser, and the starting cost of the laser is also lower than other expensive gas lasers. And we can do the surgery on a wet bed as compared to the excimer laser, which we have to dry the cornea. So I told you before, we used our laser for the trial in 45 locations worldwide. So that we have a lot of testimonials, and every surgeon which we are using our laser is very, very happy about the outcome of our laser. Yeah, we have some other product development plans in the future, and our lasers can be used for the glaucoma, and we are working on it. We are planning to have a faster laser with a 400 Hz laser, which can reduce the surgery time by 25%. And we are planning to use our laser for industrial applications. So there's a lot of new products and the developments also on our way in our company. This is our team. Like me, Mukesh, I have more than 26 years experience in this industry. Our medical director is a world leader ophthalmologist, and he has developed a few techniques of this industry. And Frank Janin, who is our operational manager, he also has nearly 20 years experience in this industry. So, this is the end. We are very exciting about this technology, and we have a potential to dominate the world market with the solid-state laser. And the market size is very big. If you see this slide, is a very big world market and is growing by 7 to 8% every year. And we are confident that we can capture a very big share of the world market. So we are looking for the 2 million, and we are confident that we can give a very high returns on this investment to the investors.
coming up now is one of my favorite people to have a conversation with. This person has been a mentor on the sidelines to me and also helped influence a lot of my thinking around Wholesale Investor and some of our plans for going forward. This is one of the most enjoyable fireside chats. It's with Tyler Tan, who's the investment director at Skyfield Group, which is a family office. His ability to articulate what he's looking for in markets and in opportunities is quite profound. So whether you're an investor or a founder, this is going to be a powerful session for you. Hi, and welcome to my next interview for Emergence 2021. Today, I am joined with Tyler Tan of Skyfield Capital. I've had the great pleasure of getting to know Tyler over the last few years as a friend and also as a mentor. So welcome, Tyler.
Good to be here, Steve.
So Tyler, how I got to know you was obviously, it was actually at one of our events where I bumped into James Spenceley, and he introduced me to you as one of the investors and as a board member of Airtasker. And over the time I've got to know you, I've said I've been fascinated with your philosophy on the way you look at investments, the way you look at opportunities, the way you look at markets, and just your perspective and how you dissect an opportunity. So the question to start with, like, what was it for you that appealed about Airtasker? And then secondly, what was it appealed to you about the space that they're in, being that sort of gig economy or that sort of home services space?
So I'll start dissecting that two questions of yours in two different ways. So one from an investor perspective and one from a business, why I like the opportunity. So if you look at Airtasker, it's a horizontal marketplace. Horizontal meaning, it tackles all sorts of categories of jobs, all types of users, different demographics, different cities. And, what I like about that is it's actually solving a real problem. The problem is when you're in a new city or when, you have a new task, whether it's a plumber seeking someone to walk your dog when you have to be running off for work, you have nowhere to turn to, besides the traditional yellow pages and through words of referral from your friends and family. There literally isn't any Google, way where you can figure out, can you trust the plumber? Can you trust the nanny? Yeah. So they're actually solving problems, and their whole mission is to create products and technology to solve the problem for you and I. So that's from a very fundamental business problem that I see. There's a clear problem to solve. And it requires years of figuring out a solution or many multiples of solutions for different types of people. So from a investing point of view, what I like about Airtasker, as you can imagine, if you are just focused purely on one vertical, like say cleaning or plumbing or online work or design, at some point, because you're so focused on that vertical, you build a brand for that vertical. You're a victim of your own success. Because when you try and do something else, you can't grow the brand. People associate, say, XYZ brand for, say, cleaning or walking the dog. You can't just go and do a nanny job. You can't do anything else because you built the brand. You are a victim of your own success. So what that means is you also have a vertical that has a finite TAM, meaning people will understand that this vertical has X billion dollars of value and growing at this size. So it's a very finite TAM. Which is great for a lot of people. But for me, I like verticals or industry or businesses that has infinite TAM. And you're actually growing that TAM. And people can't quantify it because, as an example, on an Airtasker platform, you could get someone to pick up a drone from a tree. There's no TAM for that. How do we quantify that? It has never been around for the last 5-10 years. And that's just one of many other tail-end jobs that you can figure out. So what that translates is you're actually stimulating the velocity of the economy. You're creating a job that has not been around. So in a way, you're creating mini TAMs for all these little jobs here and there that people get unnoticed. And as an investor, I find that very appealing. It's infinite TAM. People are just looking for the TAM for cleaning, the TAM for plumbing, the TAM for walking the dog, but they're missing out on the infinite, the undescribed, unquantified TAM that appeals to me. So meaning the investment is very under the radar and is not very visible for a lot of people. And that's where I see that value. And that's what I love about a business or investment opportunity in this context. I hope that answers your question.
Yeah, no,
in
it's
different
perfect.
parts.
In fact, I'm even going to bring it back a step forward because you were actually looking at this space beforehand, right? You found this space of interest to you because you saw that based on that philosophy, you saw that as an opportunity. Now, you obviously have the opportunity to look at the way different companies are approaching it. You look at the different business models. You get the opportunity to dive inside to the mind of the different founders that are leading the companies. What were you looking like? What was it about Airtasker that set them apart in your mind from the other, let's call it home services or gig economy based companies?
So as a starting point, I familiarized myself with the advertising online model. And I also familiarized myself with the commission transaction model. So a very simple example is not related to gig economy, but say, that everyone knows, every person that I talk to will know. Facebook has a advertising model. So it's a third party. That's how they monetize. So you and I we consume content, and so we produce content as well. So they create a cycle loop, but the advertisers actually fund the platform for us, you and I to use. So it's a third party advertising model. And then you have a Tencent model. They don't have really big advertising. In fact, they do advertising through third party, but they monetize through transactions within the ecosystem. So meaning if it's successful for a user and a tasker, they collect a fee. Yeah, we can debate about the take rate of that fee, but it's on a success of a transaction. So they call it the social commerce. It's social, but they do commerce in the app. So when I study those two models, they all have their merits, they all have their weaknesses, and they all have different challenges in scaling a model. And when it comes to the gig economy, I like when incentives are aligned with the poster and the tasker. Not to say I don't like the advertising model, but I just feel that with advertising, it's a trickle-down, model where the person with the largest budget will get ranked higher because they advertise more. And so you're not taking care of the tail end, the little jobs, the little people, the newcomers. So with a transaction model, you win, I win. You post a job, you get the job done at what price you set, and based on that, I collect a fee. If you don't get the job done, the job is not completed, I don't get a fee. So that's fair. And I like that kind of commission-driven model where the job gets paid once the earnings get paid once the job gets done. So from that, just understanding the business models, I feel that there's a longer runway because all stakeholders are treated equally and are compensated for what they do. They are all going to the marketplace seeking for a value exchange, and the value only gets exchanged when the job gets done. So for me, that's a clear alignment of the different stakeholders in the system.
Tyler, how much time do you spend to basically come to your different theses that you have before you start making investments?
Well, it's a very good question, and I don't think I'm going to please you because there's no quantifiable time that I set aside intentionally to crystallize the thesis by and large. So it could be as quick as a day if the idea and the business is really sound and is very clear to me. So you get the ideas for your thesis from companies. You don't get it from observing other opportunities? Both. So obviously when I look at other companies, I form my own thinking. That's one way. And also, I like to be very open-minded and meet founders and management teams because that's the source of my thesis as well. So getting into their head, figuring out what problem they're trying to solve, and be taken on a journey, and that forms my thesis as well. So the answer to your question is two ways. You can be very simple, like a founder has explained and articulated to me a problem, and I empathize and I can feel the problem. So that's a very clear thesis already. That there's a demand for that because when you have a problem, there's a market for that. So and your job is to create a solution for that problem. So then I crystallize. Oh, that's a very good thesis there. So if I need to take days and months to figure out a solution and understanding the problem, that's not an investment opportunity for me. So for me, it's very clear. Once I see it, I know, okay, then there's a thesis. But others, it takes a long time because it's something very different to me. I've not met any founders, I've not met any management teams. Then it can take as long as a year or two to figure it out. And at the end of the day, I might not figure out whether there's a thesis for me. And that's great because that's a journey.
Yeah.
Now, at least I know what I do not know. At least I know what I should not invest in because that's clearly a thesis that I don't understand. And I stay away from it. So it's not that the outcome is unsatisfying given the time I've invested in, but there's this journey that made me realize, actually, this is not a field that I like to participate in. I try so hard, I learn so much, and yet I cannot figure out how to get around the solution to the problem they're trying to solve. So I hope that answers your question. It's not a very quantifiable
No, but it's good because what I said, I love the way you think. And actually one of our first conversations, you actually helped install into me a psychology around for my specific area. In fact, the first thing you said to me was that you don't like my business model. And I thought that was really nice. And then you explained as to why. And then you highlighted to me that a lot of the great tech companies that we have seen, they've been able to do two things: aggregate one side of an ecosystem and then commoditize the other side via their platform. And that stands true to obviously what Airtask has been able to do in being able to aggregate users and then also being able to commoditize the transaction via the suppliers. And the next part to me, so that's forming the thesis, right? And I think that's interesting. The second part is obviously having a chat directly with the founders. Now, when you're having your first discussions with founders, what types of questions are you asking, and what are you trying to get out of them? What are you trying to understand?
So, on a very high level, I think most investors, most people who with capital to deploy, whether they are retail or institutional, they're always trying to figure out from the founder what is the problem that's trying to solve, right? And that's very clear to me as well. So trying to understand the problem they're trying to solve, that's one. The second then is, are you the best person or do you have the best team to solve that problem? And two, so that's the second level of questioning for me or understanding. And the third level is, why are some conventional solutions failing to solve the problem? What is the problem that they are facing that you think you can create a new solution for the problem? So I want to understand what is a conventional solution to the problem and what is the difficulty for the other founders in that space trying to solve. And what is your solution so different from other solutions? And what makes you feel that you are confident in executing that solution to that problem? So there are multiple layers, but it takes me through the journey of a founder trying to solve the problem, finding a different way to solve the problem, and finding a different way to scale the problem and to solve the solution. And through the journey, I understand the founder better. So then, the next step would be, okay, so can I see your vision, your story of solving the problem through a product? Is the product telling me what you say, right? So when I look at the product, I will be figuring out, okay, so there's a problem there. And this is what the founder has told me that he's trying to solve with this feature and that feature and that feature. And then you try and piece together and try and connect the dots. Do they all connect to a story? Can you tell a story from the product, what the founder or the management team has said about how severe is the problem, how frequent is the problem, how difficult the challenge is solving the problem, and they try so many solutions here and there, and they found that this solution they think can work best. And do you believe in the solution? If you don't believe in the solution, you should not be part of the journey as an investor or as a shareholder. You need to believe in the solution, and you need to think that the solution can work. So
that's one step, right? Having a solution that can work. You mentioned something very specific about, is there a scalable way to solve that problem? What questions are you asking the founder about their business model, their thinking, their structure to help extract that out of their minds, how they're approaching it?
So scalability is a process. So you need a mixture of infrastructure, your team, the back end, the front end in today's day and age. And also where you deploy your capital, right? So if you can imagine, very, very high level, very simple terms, I'm the best chef in the world. I sit in my kitchen, right? And I do the best work that I do. Customers come to me because I cook best, but I can't scale. There are not many Thailands around to scale. So I need to invest in the time and effort to hire new chefs, up and coming chefs, and try and train them. and that system or that religion of finding more and more pilots to train, that is what we call by scaling. How much effort you take, what are the systems and processes that you have to invest in to create more and more pilots so that they can, grow your franchise. So it's a very slow, steady process of trying to scale, because no one knows how to scale. It's very difficult. You need experiments. You need trial and error. You need patience of investors who are willing to put up the capital for you to experiment. And that scaling gets better and better. But hopefully, you can scale yourself out of the problem. So, then you can talk about, areas where you can scale, like marketing, performance marketing, above the line marketing. You can talk about scaling your infrastructure, your front end, your back end. You can scale a lot of resources up and down across the geography, across verticals. But at the end of the day, it's a process. It's a culture, it's a discipline that the team should be able to figure out how to replicate and do it in a very repeatable way where we have a go-to-market strategy. We know what works. We know what doesn't work. And this is how we scale. So scaling is although it can be very technical.
And are you looking for product-led companies that in a scaling model, or a technology-based scaling?
Well, I'm going to disappoint you again. I have a lot of answers to a lot of different questions. So subject to different industries, subject to different business models, sometimes I like brands, meaning the investment dollars, the capital that you raise from shareholders goes to building a brand, right? So that is specific to certain industries. I love that. In some other industries, which is more my inclination, you don't spend the money on marketing. The product pulls the users. So there's a pull effect rather than a push effect. You're not trying to spend money to subsidize, to get them incentivized to come to you, because these are the users who are going to tail away. They're going to churn away because they're only attracted to you because of your marketing dollars. But it's the product that pulls people. And the reason why the product pulls people is that's a real problem to solve. And people love your product. They come to you. So that's the product-led growth that I am more inclined towards. And that feeds inside. Then you're looking at how do you scale multiple products or multiple features so that you don't get stagnant. You can get out of the asymptote, to get out of the next S-curve. And that's the founder or the management team has a culture of experimenting. Are they fearful of experimenting? Do they have a consistency in developing a product? And what is the velocity of the product development? I was going to say,
and if they're doing that, if they are experimenting, if they're trying stuff, if they're failing, how are you supporting them as a shareholder in that, or as a board member?
Well, it's a double-edged sword. Obviously, when they experiment, and in reality, those experiments don't turn out well. Well, that's the reality. That's a VC world for you. And when they don't turn out well, they burn cash. It's written down, right? So it's a very painful mistake as a shareholder. And then, most likely there will be another capital raise, which means you will have more dilution, right? So that's one angle that all investors, all shareholders, and all board directors, including the CEO and the founder, will realize experiments are hard, but they are necessary. So the key lesson is, why did you do the experiment? Why did you design the experiment? What were you trying to solve first? And then if the experiment turns out not well, what have you learned? I think that's more important. So that when you design the next experiment, you would have learned something. It's a learning curve, right? So that's scaling as well, because you need to make mistakes for you to figure out the right product market fit, the right product channel fit. Otherwise, everyone is just born with natural flair. It's impossible. That's not how the world works. It's through failures, through mistakes, through experiments that one gets better and better, and you create a flywheel of experimenting, failing, and then hopefully that through the journey of a shareholder, you see the light in the tunnel. You found a product, that has the right market fit and with the right price point. You find the right cohort of users, and that's when you realize it's through the years of hard work experiments you figure out you have the aha moment, the eureka moment, and that most founders will be proud of. But it's a long process. It's a long journey. No one gets it right the first time.
And for you, like obviously the last 12 months have been, have obviously challenged in different ways. What's your perspective on the investor side? What's been your observations? How have you compartmentalized it? What have you learned from the last 12 months?
Well, one thing that I have learned, or one thing that has validated my thinking all the while, is investing is not easy. It's never easy. Whoever thinks it's easy should be lying to themselves. There could be occasions that there could be luck here and there, but that's one-off. That's not consistency. And what I've realized is you can bet on the right industry, but on the wrong player. You can bet on the right technology, but at the wrong time. You can bet on the right horse, but at a very exorbitant price. There's so many factors, whether it's the business model, the market pricing, the founder team, who left out, who fell foul with another partner. The list of risk goes on. There's no silver bullet. And as an investor, or one should be like a student, like going to a classroom where you have a lot of peers and you have teachers to guide you through a learning process. I think it's through accumulation of experience and time, and especially failures, for one to realize how hard investing is. And otherwise, everyone should just buy an ETF or should just buy a CBA or a BHP bulletin that pays a dividend. Then if that's investing, that's great. It's also for investing, but you don't get the know-how of compounding your knowledge with compounding your capital. So compounding capital requires compounding of knowledge and that know-how on how you execute your investments. And to me, that's something that I will be a student for the next 50 years of my life.
I love that line. The compounding of knowledge, or the compounding of capital requires the compounding of knowledge. I absolutely love that line. And as you're thinking about, obviously you get to see a lot of, how many opportunities would come across your office in the space of a month?
Well, if I annualize this, maybe about 10 in a month, more or less. Or maybe.
And they're from trusted referrals, typically?
No, they come from different sources. Okay. Like I said, I don't have a very clear answer for a lot of questions by and large. Sometimes the best investments are outliers, anomalies. They come from different parts of the world. They come from different places, of the most random people that you can meet, of the most random founder that you can think of. When they are very trusted, when they are very secure, you have a funnel, you have a process, that's very mainstream. That's beta for you. That's what I call that's beta, because everyone is looking at it. It becomes very obvious. Then where's the investment alpha? That's my honest answer. So my sources come from everywhere. Anyone. It's very random. I could look at 10 deals in a month, or even just 2 deals in a year. Time is of essence. It's about figuring out what is right, not what deals can I do, what investments can I make, how can I exit. I mean, if you have those secondary elements, then it's hard to be a professional, true investor that always, perfect your skill every single time. It's a drag, it's a long marathon. Yeah.
And for now, as you're thinking about this next sort of 5 to 10 years, what sectors are you looking at? What's your underlying thesis about how you're sort of assessing different technologies, different sectors, different market environments, even different countries? What's your high level thinking on those different areas?
Well, I've always believed in the internet and the power of mobile phones on what they can do to create new economies, new companies. Like, for example, Uber is built on an Apple app, right? So without the Apple Store, Uber would not be around today. And so I think there are still plenty of opportunities. We're just at the very beginning of the internet mobile revolution. We're still at infancy for the cloud adoption. Everyone is talking about the cloud, but how many applications, how many companies are actually cloud native? They are hosted in the cloud doesn't mean they are cloud native. They are built for the cloud. That's a different mindset, and it requires cannibalizing whatever that you have. Whether they are data centers or servers on premise, you need to kill off the goose that lays you the eggs for you to be really cloud native. So I see plenty of opportunities still within blockchain, within internet 2.0, 3.0, within edge computing. I love that space. And I still think we have very long tailwinds in this sector. Just different applications, different ways, different business models, different innovative ways of how you tackle a problem, go to market, solving problems. They continue to be the same for the last 50 years, and they will continue to be the same for the next 50 years. But it's just riding on the new platforms, like say internet, mobile, blockchain, decentralization, and they take different shapes and forms, and companies will, hopefully, go away and decay, and then there will be new companies, with new blood, new youth, rejuvenating the economy, and that's progress. That's evolution of societies as a whole. And so I can't be more excited. Everyone talks about the China-US tensions. Everyone talks about being a competitor. The geopolitical crisis, the socialism, the inequality in many parts of the world, in the West and in the East. And they are natural evolution of human beings and as a society. And they are painful, they are tough. And I can empathize a lot of, dissatisfaction with the establishment. But at the same time, these are problems. So with problems, you just look on the optimistic side. With problems, there will be solutions. And when there are solutions, there will be investment opportunities. And so I keep myself optimistic in that way. The more problems I see with China, US, the more problems I see with inequality and climate change, the more opportunities I get excited about. Because I know there will be, in some pockets of the world, there will be founders and there will be management teams trying to solve the big problems, like taking us to Mars, as an example. Whoever who says that, resources are finite. Nah, that's not true. Resources can be infinite if we, take ourselves to Mars and planet Moon. So, there's always a good problem to solve. So I'm very optimistic about the future.
I always love how philosophical you are. Now, final question, because I know how much it's helped me. So this is more for founders, right? And I said, I know the difference, said the way you think. What would be the advice if you were to sit down with, if you were to sort of speak to a group of founders, what would be the advice that you'd give them as far as from what you've seen about what it actually takes to build a successful, high growth, scaling business and see it all the way from the early stages right to exit? What's some of the advice that you'd give to founders in advance of going through that journey?
Well, I'm not in a position to give advice. I don't prescribe anything. By and large, I'm still a student, as you remember, right?
From your observations, I should say, because you're always observing.
Yeah, but what I can answer you is in my way. What was the question that I should be looking for, or what trade should I be looking at? Always have a mission, have a purpose in life. I think that's something that I seek and look out for in all types of people, whether they are founders or investors. Once you have a mission, once you have a purpose, you will figure out a problem that you intimately care about. And once you identify that problem or set of problems, whether it's something that you can relate to or something that you can relate to the society or the environment that you relate to, you will do whatever it takes. You will pull in resources, you will bootstrap, you will hire the people, you will build a culture just to solve the problem. And when you solve that problem, to put it bluntly, the capital will come in. That's in my opinion. It starts with the purpose and mission. What are you solving? Why do you care so much about the problem? Is that problem really a first world problem? Or is it truly a problem that is very universal? And do you have the best solution to it? And can you build a team to solve that And do you let go? Do you persevere? There will be hardships. There will be a lot of failures, experiences that go down south. But you know what? Your mission and your purpose will take you to the solution. That's the only thing that will take you to the solution. No, nothing else. Your capital will run away. Your shareholders will run away. Your team will run away. Your culture that you built over the last 10 years will run away. But you as a founder, you as a management team, you have to dedicate yourself to the purpose and mission. And that's what I seek. So I can't say that for a lot of people. I can't prescribe that to all the founders that I meet. Everyone is different. But I seek and understand, what the founder that I like to back. Or the team, it doesn't have to be a founder. You could be a management, you could be an ex-CEO, you could be a CFO, or it could be a true technology guy. Everyone has their own purpose and mission, I believe, right? It could be faith, it could be a religion, it could be a family, it could be someone trying to do good for the country, or it could be anything. So I always believe human beings need to have a purpose and mission. And that's what I ask myself, and I challenge myself all the time. So I think that's something that I would like to say to most people, in your conference. Like I said, I can't be a priest. I'm not a teacher. I'm still a student. So that's the way how I answer. It's not an advice, but that's what I seek in an investment.
Well, Tyler, I just want to say, as always, thank you very much for your time. I said the keep on telling you the insights that I get from you, and I'm sure the insights that people have gotten from this session. So it goes a long way in having an impact in the way in which people go about and think about building their businesses. Thank you very much, Tyler, for your time.
You're welcome. Thanks for bringing me on.
It's my pleasure to now introduce the Family Offices panel session. Here we'll cover topics such as what family offices are looking for in companies, what motivates family offices to invest, how family offices leverage their networks, and what they can in turn offer their investee companies. Our panelists for this session include Mark D'Ambrosis, who's the Managing Director at Armitage Associates, Wei Meng Tu, who's the Head of Investments of the TMT sector at Leone Hill Capital, Roger Allen, who's the Chairman of Patagorang Investment Group, Patrick Alaka, who's the Investment Manager at Pantera Group, and it's moderated by Karen Chen, who's the Head of Investec Emerging Companies. Enjoy the session.
Hi everyone, welcome to Emergence 2021. We're really excited to have you join us for the Family Office panel. And with our guest today, I'd like to start with introductions. So first of all, I'd like to introduce you to Wei Meng Tu from Leone Hill Capital.
Hi, everyone. Good afternoon or good morning to you. I'm Wei Meng from Singapore, and we are a MAS-registered family office in Singapore. It's also a private equity and venture capital company. So we pride ourselves as a tech-driven family office investor. We've been investing extensively globally, primarily in the US, Japan, China, India, Asia, and into Europe. So quite widely spread into companies like Alibaba since year 2000, SpaceX, Tesla, Japanese robotics Fanuc, Olympus, and etc. Recent years, we've been investing a lot into highly disruptive companies into deep tech. So pretty much as all of us know, the disruptive force. So we have been very near to all these businesses. And we pretty much pride ourselves from really taking an entrepreneurial approach, investor approach, and also with the technology approach. Thank you.
Great, thank you. And then I'd like to have Mark D'Ambrosis introduce himself. Mark is the Managing Director at Armitage Associates.
Thanks, Karen. So Armitage Associates, we're a Melbourne-based firm focusing on growth equity investments into small, medium-sized businesses here in Australia and New Zealand. We're really focused on investing in family-owned, privately held companies where a founder is still in the business. They're looking for growth capital or sell down capital and an active partner to help them grow their business over time. And the reason we're probably relevant to this conversation is all of our investors are family offices. So we are very much family office capital for family-owned businesses, and look forward to talking about some of the trends we're seeing in that market.
And Roger Allen from Patagorang Investment Group. Can you share a few words on your background?
I started as a tech entrepreneur way back in the 70s. Built a deep tech software company starting in Australia, but went global. Went public in mid 80s, and when the company was acquired in the mid 90s, I set up the first early stage venture capital company in Australia. Set up an office in Silicon Valley. I split my time. I bought a place in San Francisco. I handed that over after 3 funds, but I continue to invest my own private money. So I have a venture capital portfolio of companies in the US, one in China, but I've had several in China and in Europe, as well as Australia and New Zealand. So I have a portfolio of about 40 odd companies in my private VC fund, as well as, of course, investments in public markets and real estate, etc. I've also created a foundation to focus on tackling social problems through venture capital principles, in particular helping Indigenous people, which is one of our biggest social problems in Australia, to start up their own businesses and grow them as a way out of the poverty trap and the like. So my focus is on social impact investing and in technology investing.
Great, thanks, Roger. And over to Patrick Halauka, Investment Manager at Panthera Group.
Hi guys, hope everyone's good and there's not much echo now. So I'm from Panthera Group, and basically we are shopping centre owners where we own shopping centres across New South Wales, but we also invest heavily in technology, and we have our own funds management business for both property and technology, which is mostly funded by the founders and family offices. So we deal with family offices quite a lot, and we are seeing a lot of trends in terms of investment from property to technology. And we actually have investments into other technologies too, while we also invest in our own technology, which facilitates better solutions for retail asset owners, and is specifically targeted towards retail asset owners. We still have the co-founders and principals of the company as the major funding source, and other smaller family offices who participate with us. Thank you.
Great. So I seem to hear that technology seems to be a recurring theme for all the family offices we have here, which is great. My first question relates to just how, in global recessions, such as more recently with COVID-19, how that has actually impacted your family office generally, and more specifically, what are you seeing in the Australian market?
Yeah. May I go?
Absolutely, Patrick.
Yeah, sure. So look, we have dealt with a few family offices who have had a very high level of focus on property and very traditional property. And they have come into our fund quite early on and invested in retail property. But since then, we have actually created a solution which allows them to access more of the digital market and offer their retail solutions in a digital format, especially during COVID when people weren't physically able to come into the shopping centres. And there's been a significant level of interest in investing in the technology side of the business instead of the property. And more and more investors are getting sophisticated about technology. They're seeing the viability of companies like Uber and Menulog, who have done extremely well based on projections and have actually tracked through a lot of projections. So they are quite interested in working with startup companies and working with upcoming technology companies, and not just focusing on traditional asset classes.
And Roger, what are you seeing? Are you seeing sort of similar themes to where?
Well, I'm always my main investments are in technology companies. Most of them have actually done exceedingly well. Obviously, the ones that my actual biggest company by value is an e-commerce company in the payment space, so that has benefited a lot by what's happening with COVID. As we know, it's accelerated the trend to more and more online, etc. So I have a number of companies in the health space in the States, which were impacted in that in the medical area, there are a lot of face-to-face calls at hospital level, etc. We've turned that into a positive because I've been trying to lower the cost of customer acquisition anyway, and it's hard to get senior doctors, radiologists and others, away from having face-to-face calls. So we've used that to actually be able to significantly increase our online marketing and sales. The other big thing is the SaaS model, really holds up well, particularly in the enterprise space, because you've got recurring revenue. It's built in. It's built into the workflow, if you like, of the enterprise. So we've seen very low churn rates, whereas more on the consumer SaaS side, people can cancel quite quickly. So the companies with good enterprise SaaS models have tended to not be impacted that much. There have been a few companies that are a bit more impacted than others, and some of my property companies have, where we've had to do some significant changes. But by and large, tech companies, have boomed really as a result of COVID.
Yeah, I think it's interesting hearing Roger speak. I mean, we at Armitage have about half of our companies as pure play software or software-enabled business models. The other half are more real economy business models, and it has been interesting to see who have been the beneficiaries of COVID. And it's not to say that all of the real economy business models have been negatively affected. Quite the opposite. Some of those business models have actually seen tailwinds as a result of what's happened over the last 12 months. But it is fair to say that those digitally enabled, software-enabled business models have absolutely come out of this period in much better shape. And I think, back to your original question, Karen, about family offices. I think we're not a family office. We obviously invest on behalf of a large number of family offices. I think the interest in technology was always high before COVID came along. I think this period has just reinforced that demand or interest, particularly from our investor base, in seeing what are those business models that have been beneficiaries of COVID over the last 12 months, and who are set up to continue to benefit from that once the world returns to whatever the new normal is.
And I think pretty much family office during this pandemic crisis, a lot of them actually had a toll on their portfolio because primarily assets in the real economy space has been all hit hard. For instance, for us, although we've got quite a strong tech portfolio, we've got also a lot of those assets class sitting in the back, like aviation, oil and gas, and etc. So we during this trying times, what the team has put forward with is to really look at how to redeploy some of the capital, and pretty much we have been. As a result, we have been studying how the response to the pandemic. So because we are very tech savvy, we tend to now look at things a little bit different. So one of the things that we are trying to do internally is also to transform ourselves with digital. And we had put in quite a fair bit of money trying to bring in all the innovation and creating this transformation for the old business. Whereas for the new business, we are looking to create an impact that directly responds to the COVID. One instance is we invested into companies that has advanced diagnostic to accelerate health screening and border control, so that will help the government to accelerate, as well as to make sure that they've got a more secure border health screening point. So we have been deploying this in some of the emerging countries where the lack of the front line workers, lack of the training. So we need to do more automation that making sure that the accuracy and the time clearance for each of those screening time, instead of just taking one swab, goes into nostril and start to dig and take about 15 minutes. We have been looking into some piloting technology to help accelerate those mission critical mission in the health screening space.
That's great, Wee Bang. I think that is a good segue to my next question, which is actually how all of you, whether you're representing a family office or also investing on behalf of family offices, what sort of trends or different sort of areas of investment are you focused on now, just given the changes in the external environment? Clearly, there is a shift towards more digital tech-focused businesses. I might actually go back to you, Patrick, just given you deal with the real property space and you're trying to also digitize it. So I'd love to hear what you're investing in.
Yeah, thank you, Karen. Look, there's definitely been a very strong shift, especially due to COVID, for our investors to invest in technology that supports real property. So one of our own technologies is called Rivershop, which essentially allows any shopping center owner to provide all of the services in a shopping center to a digital trade area. And we have had a lot of interest in that particular investment category or that product over the past few years, but it significantly grew when 2020 hit, when COVID hit, and it was in real need by all retail asset owners. And we've seen a similar trend in other technologies that we are investing in on behalf of the investors as a fund manager. So we're investing in technologies which facilitate digitizing tables, so people don't need to go and queue up and essentially stand in lines with social distancing rules, but can order from their table in a shopping center as a digital table with a touch screen. And the interest in that significantly grew because it was still facilitating trade in shopping centers and helping people who are coming in see and do things easily or better. So going back to Wee's point, it is correct that the biggest thing that's going to lead to a higher investment in technology is things that will either automate or improve current things. And for us, from a retail property perspective during COVID, a lot of the technology that supports the physical shopping center has gotten a lot of support from the investors because it's got a very clear market space now. The demand for it is very clear now. So, yeah.
Right. And Mark, how about you? Are you more focused on certain types of industries or
Yeah, so our model probably hasn't changed too much as a result of COVID. Our focus is non-discretionary recurring revenue business models, about half of which end up being software business models, half of which are more real economy models. I think what I would say, as opposed to changing the way we think about those end markets and investing, what the last 12 months has done has probably reinforced a couple of things. The first thing it really reinforced is, we don't, as Armitage, we don't invest in discretionary consumer business models. I think that you'd need a period like this just to reinforce that model. So in that sense, I guess we've been fortunate. I think the other thing that has changed, is changing, and it'll be a question of how permanent this is on the software side. It's been interesting to see what has happened to valuation expectations in software businesses, particularly for an investor like Armitage, who are very much focused on cash flows and traditional profit metrics when we think about valuations. Moving into a world where assets are trading more on valuation metrics linked to revenue, and it'd be interesting to see how sustained those changes in expectations are for a lot of these technology and software companies. And Roger, I'd be interested in what you're seeing in that regard on the VC front, because we've certainly seen pockets of the more traditional growth equity market that we've invested in, where you've seen step changes in valuation expectations, which we haven't necessarily participated in. I'm not sure if you're seeing the same kind of thing in the venture end of the market.
Yes, I'll come to that. My three themes that I particularly invest in is digital health. So health applications, but really driven by software. Some of that is embedded, but it's not new drugs as such, with all that implies. But there's a real macro trend of the IT and telecoms world, into the health sector. So I have a lot of investments in that space. One of them was a UK company, but one of the leading telehealth companies. And needless to say, its volumes went through the roof with COVID, and we actually listed that on the ASX in December. The second area is similar to it's enterprise SaaS companies, in particular in the Fintech sector, and some emerging ones in the AgTech sector. And the third macro theme I invest in is all around cybersecurity, which itself is a broad category, but my most recent one is visual analytics, AI analysing from CCTV footage, etc. Yes, you're absolutely right. The supposed new norm is large multiples of ARR, or recurring revenue. It's a little bit more. You have to be more discerning than that. It's really got to be high growth companies, recurring revenue, non-discretionary, as you put it, will build into workflows, high gross margins, high increasing ARPU, and low churn. If you put all those together, then obviously people extrapolate that eventually those companies will become, or can become, profitable. It's an open question as to whether this really is a bubble, and there comes a point, if companies don't meet those metrics, if their growth rates fall off, etc., then they can be dealt with pretty severely, quite quickly, and come back to more, even still pretty high valuations, if you like. That of course flows down into the private market. So one of the problems is, even people in a very early stage company, they look at comparables in the public market and think, 10 times ARR, what they think they might do next year is, a good starting point. So it does put pressure on. You have to be very disciplined in investing and structuring investments correctly. I have either the advantage or disadvantage of having been through 4 major corrections since I listed my company in '87, just before the crash, then the major recession in the early '90s, the dot-com crash, and then the global financial crisis. So I've tried to impart some of those lessons to people who've only ever known it since the last 6 or 7 years. and try to position companies. Certainly one of the things with COVID was to really make sure your first priority was your current portfolio, make sure that they were okay. In a couple of cases, did some capital raisings just to make sure that even though you could think you could get through, you just never know how long these things are going to be, and you don't want to be trying to raise money when you're running out of money. So a lot of experience from having been through a lot of these issues, but there doesn't seem to be any slowing down or coming back to more fundamental PE type ratios. The clamour of the better companies, both in the private markets and in the public markets, is so strong. I mean, what we're talking about is obviously happening globally. The amount of investors wanting to rush. Even, people were investing in tech before COVID. COVID has highlighted, a lot of these tech companies, e-commerce related, et cetera, et cetera. So it's, demand and supply for the better companies. They are commanding, really, really high valuations.
And definitely seeing that on the public markets where, a lot of the tech companies are, reaching all-time highs, on a daily, even weekly basis. So it's very exciting at the moment, but also we're seeing that trickle down to private valuations as well.
No, I wouldn't call it a trickle. I'd call it a flood.
Flood, yes. That's very true. Wee Meng, what are you seeing over in Singapore? Are you also seeing sort of the same sort of trend that we're seeing here and even more broadly in Asia with respect to valuations?
Well, definitely the valuation exercise has changed. I think we are seeing that there's a lot of the businesses in the cash crunch, and therefore I think they have to come to reality. And for us, we are looking into not just deploying a risk capital, but we must also look at how to transform the investment strategy. And because we are a single family office-backed fund, we are also constantly trying to bring the new generation of the FO members looking into investment. So we have switched from a profitable investment into a more responsible investment. So that's where I think the case of valuation, in my view, for different asset class has to come into not just technology play, but also what has changed in this new world and how this whole mechanism of the business model works. For instance, we used to do a lot of tech investment. Now we get into infrastructure tech investment. So for infrastructure tech investment, right, of course, it's a longer horizon. But renewables, you don't just create an asset class of those solar as well as wind and hydro, but you look at the tech behind that would be able to mitigate the risk as well as to create that we call it the network sharing effect of grid. How do we create resilience in grid? So we, because we have invested in a lot of technology that requires infrastructure, for instance, Tesla. So we had also moved into some big tech space where at the infrastructure level, how do we capture carbon effectively? So these are those technology that if you look at valuation, in the past, it has been very high valuation because of, the whole world is all talking about that. But now I think we've been seeing some new tech coming from Europe. I think people has been really getting more reasonable, where they think that they are able to give some little to strategic investor, and if we can take them to the next 3 years, whether into a new frontier or what, I'm not sure, but it's too long to gauge. But for now, we look at valuation more strategically as something reasonable but that must be an impact where we can create from an infrastructure point of view.
If I may jump in, just very quickly, sorry, Karen. To the group in general, we spoke about valuations a fair bit, but how do you guys value data? Because that's the biggest X factor in most of these technology companies, where they're capturing vast amounts of live data like Uber and etc. And there is some sort of value that can be attached to the data they're capturing, depending on how it can be used or how it can be used by the company or other companies. Do you guys take that into valuation when you look at a company?
I would say, I would tell you that virtually every company pitching tells you that they have this fantastic data and the like. When you really drill in how they're going to monetize it, most of them haven't got a clue. And so it is way overhyped. You know, people talk about data lakes and the like. So you really have to understand how you will monetize that, and some of the IP and intellectual issues around it. We saw Google as an example do a whole thing on one of my companies does early detection of breast cancer, and they did this. They said, "Oh, we've got this AI. We're going to be doing breast cancer," and they never had proper patient permissions. They went to a health clinic and got this data, and the whole industry then just completely reacted dramatically because they didn't get proper, even though you might have anonymised data in some areas. But anyway, so a lot of people don't understand all the privacy issues and regulatory issues, and we know that landscape and regulations changing. It varies, you know, between the European models and US, but I would tread very cautiously about people who claim they're going to monetize the data. I'd want to see some, real hard evidence of how they're going to do it or how they are doing it.
Yeah, I'd agree with that. And I think there's just different DNA in a business. You know, there are certain businesses and entrepreneurs who built businesses around those kind of models. You know, we're lucky to be investors in a company that IPO'd at the end of last year called Nuix, whose business model and reason for being is all about data and being able to take large volumes of unstructured data for e-discovery and investigations purposes, process that for the users of or the owners and the users of that data. That business and the DNA of that business is very different to other business models, particularly the real economy models, where they may have access to that information, as Roger said. Whether or not they can actually legally use it or not is one thing, but whether or not they've actually got the capability within their business to create a business model around that, I think is even more difficult a lot of the time. And it's something that we at Armitage in our business have actually gone so far as to invest in resources within our team to put into our portfolio companies to enable them to work out how they can think about using and monetizing that information. But absolutely agree with Roger. I think that's very easy to say and very difficult to do.
Yeah, and Nuix I'm an investor in Nuix too, but that's really very different. That's data, that's data within police and security agencies and the like.
Right, great. I think we've spent a good amount of time just having a bit of chat as to the investment philosophies and trends of family offices. I'd like to spend a bit of time just on how family offices go about investing. So I thought I might just start with actually asking the group here if you're seeing an increase in co-investments amongst family offices. So I wonder if anyone wants to take that one.
Well, yeah, I can. It's because my whole background's in technology investing, so I've had a lot of family offices that typically haven't done much technology investing, referring things to me or wanting to co-invest and the like. So it is a learning curve for some family offices and the like, but also some of the more successful tech, like the Atlassian guys, for instance, setting up their own funds. Typically, in most of these early stage companies, you've got 2, 3, even 4 VCs, whether it's family office VCs, direct your own money, or whether it's more institutional VCs. But that's pretty standard, and certainly family offices that don't have, they haven't got the full capability of a venture capital, professional venture capital firm, definitely like to invest together, and someone's going to do the heavy lifting. And of course, there's the old, fear of missing out. I was looking at one where no one had made a decision, no one was committed, and I said, "Great, well, I'll take all of it, thanks." And they thought, "Oh, we'll just do a
really good.
We don't want to upset these people. Some of them are, and of course, everyone piles in." So quite often, if somebody takes the lead, then you'll find family offices that maybe not as experienced or don't have a team of people to do the due diligence or go on the board and all those things, will tend to want to jump in. And also a lot of the VCs that have raised money, have also offered co-investment rights. So you're seeing quite a lot of co-investment where they're piggybacking off VC funds, which they would have put money into the fund in order to get the co-investment rights. But that model is I've seen a lot of, I've done quite a few myself, co-investment deals.
Mm-hmm.
Yeah, so likewise here in Singapore, so we do have even the circles where it's organized by MAS, and we've got 40 over family office all coming together into this, we call it the FO circles. So we do deal flow sharing, and every quarter there's a big topic. Some of us, which is more tech savvy, will come out and talk about it and share it with our other peers. So, and we've got regular coffee and, basically just sharing some market intel. So after, I would say that it's not easy as during the beginning, but after a while, half a year later, you've got some friends turning mates, then people to start to come in together to do the co-investing. So we had some opportunities to do some co-investing. And also, like what Roger said, if you participate in any of the VC funds, typically they will structure those co-investing rights that will allow you to come in to club the deal for some deals that you like to. So it is happening. I'm seeing that more family offices in Asia are beginning to pick up this trend, because they are newer FO members, the new generation of people that most of them, the second generation's got some financial services background, and they are also some tech savvy. So they will come up more courageously to talk about it and put some of their fair share into those investments.
And Mark, what are you seeing? I mean, obviously, I think the family offices would look to you to help them, vet certain deals.
Investment
amongst families you work with.
Yeah, exactly. I mean, again, we're not a family office. I think, I'd agree with what Wee Mang just said then in terms of, I think you're seeing a lot of the families that we deal with invest more internally in capability to be able to look at direct investment themselves, whether that's on their own and pursuing particular strategies. And it's interesting to see some of those strategies or alongside us in a co-investment capacity, as well as through us as a fund. I think, just as an aside to that, one of the things that we are seeing that's consistent with what Wee Mang was saying before is having more conversations with investors about wanting to take a longer term view on certain assets that they are investing in. And so, when we started Armitage, one of our core philosophies was being able to take a longer term view with the capital, not looking to necessarily trade in and out of assets like a private equity fund, but being more family office-like in so much as wanting to take a longer term view in the businesses that we partner with, that we invest in. And certainly what we've seen over the last 5 years is more and more family offices being more proactive in that approach and wanting to position themselves to be able to take longer term views in the businesses that they're invested in, whether it's through a fund vehicle like Armitage or whether it's directly in those assets that they're investing in themselves.
How about you, Patrick? What do you see?
Very, very likewise to what Roger and Mark said. Over the past few years, we've seen that there's a higher appetite for family offices to allocate funds to pre-IPO and even pre-revenue technology companies. But that is a caveat to the fund manager being us co-investing into those technology companies with them. So they do look at us for a little bit of direction when it comes to co-investment, going to your original question, but also there's been a higher appetite for them to invest in pre-IPO and pre-revenue companies where they are willing to take a long-term view on the investment and are willing to wait for the market to mature, the product to mature, to actually get profits and revenue coming back to them. So definitely it's been a stronger appetite for technology too from individual family offices.
I'd like to move on to my next question, which is how the family office approaches, I guess, the investment process and how that may compare to a VC fund. Maybe start with Roger, since you've probably got experience in both.
Well, it's a good question, and my answer is the same. And I had this company come to me, but the two key founders I knew quite well personally, and they came to me and said, we're just coming to you privately. We don't want to go to those VCs. This is after I was out of running my VC fund, but I was just for my own money. We don't want to go through all that stuff with VCs and all that term sheets and all that. I said, so you think when I invest my own money, I should invest it on terms that are not as favourable to me as when I invest other people's money? So I use absolutely standard VC terms for a start. In fact, I have a few of my own that a lot of VCs don't follow through and use properly, I don't think. I don't have, I often get this question because I have quite a large portfolio, but I don't have analysts and other people. What I have found over the years is you need your most experienced people to look at deals initially. And I think I've seen a lot of VCs make the mistake where new deals, the deal flow that comes in is looked at by, the junior analyst. It's very, very hard, obviously, to figure out, which company is going to be the most successful and the like. So to me, I'd like to look at everything initially myself first, and then I look, rather than have my own staff, I mean, I have, finance people and the like, but rather than have my own analysts in my network, I look for someone in my network. Pretty quickly I can find a domain expert, and I then do it that way. And rather than have sort of one person who's across everything, I look for, someone in the network. And if I need a particular deep dive on something, I'll use that person deal by deal. I've found that better. Or else, if I'm doing co-investment with someone else who's taking the lead, they will do a lot of the due diligence and other work. I will typically always have a look at it and suggest some things. But probably my network is probably the biggest asset within that network, you can really find people who can help a lot. The other thing I absolutely rely on is I ring up people in the industry, particularly customers. Because people, I'm looking at an ag tech thing at the moment. That's not my background, but a friend of mine's is going on the board, and he's raising money from, etc. So I'm looking at it, and so the people who really understand the technology and why they'd use it, and how much they'd pay for it, and all the rest of it. If they've got customers, I talk to the customers. If they don't have customers, I talk to the people who they think are going to be their customers. And I find you get a lot more from those people because they're out looking at everything that's on the market and the like. So I guess I take shortcuts from what what a lot of people do. I don't typically spend anywhere near as much time evaluating it or doing a lot of the typical due diligence. I've never found that necessarily. Obviously, I do some, but it doesn't. A lot of the most successful investments, there's a lot of judgment involved, and I'm talking companies that don't have balance sheets, don't have a lot of trading history. Obviously, there is you're really concerned about a number of things on IP and other things, but there's a lot. The earlier the company, the more it is about judgment.
Yeah, I completely agree with that. And I used to work for a gentleman by the name of Mark Carnegie, who was prodigious at leveraging the network, which is something that we've absolutely replicated shamelessly in the Armitage business model for that reason. I think the other two things, that are absolutely not negotiable, at least for us, and I know the first would apply to everybody in this panel. First one is the founder. It's all about the founder, and that doesn't matter how good the deal is, doesn't matter how good the business model is. If the founder isn't right, that's just something you can't compromise on, particularly if like we do, you're taking a longer term view in the kind of businesses that you're investing in and partnering with. The other thing, though, that we spend a lot of time on that, isn't necessarily novel to Armitage, but it's something that is a big function of our investment model is the first 100 days. And, even 30 days before we're cutting the check, we're investing on the first 100-day plan that really is critical to be able to set the business up to head in a particular direction, set the momentum and really align expectations for what that investment relationship is going to look like. So that's been a big focus for every investment that we make. That's a core part of our model.
Yeah, absolutely. I think the connection, the network is ultimately most important. I think for family offices, there may not be specialists that internally they are able to do enough due diligence. So we typically work with the friends out there in the market that, it's not about the financial due diligence, in my opinion. It's more of, really you understand the business that in that operating environment. More important also the founder, right? And how would he be able to execute the vision? Is still a one-on-one thing, but, because we are probably looking at them in the longer term, we want to make sure that if we can go in this stage, we can also inject into the subsequent stage. So it's about, working with him in the long term. It's about the journey. So a lot of the time that I spend is really onto the people factor.
And how about you, Patrick?
Definitely in line with what the rest of the panelists said. We found that working with VCs from all over the world, the key thing is the founder, the product, and the customer. So before we invest in any company, we want to know all of those three things, three people groups very well. And similar to a VC going in and investigating a completely new investment, we try to do the same thing. The only different approach that we have is we are very strategic about the investments we make, being in retail and property related, and in technology supporting the retail property. So we actually know our investments, customers very well, and we ourselves are one of their customers in most cases. So it gives us a more in-depth view of the product and allows us to help them further. So from an investment perspective, we differ a little bit from VCs where they don't traditionally know the market or the product line that well, and we do. So that's the only place where we differ from VCs while investing as a fund manager.
Okay, that's great. I think, Patrick, this is actually my next question for the rest of the panelists, is actually what can the family offices offer the investee companies that would make them want to take your capital over, say, a VC fund or another type of investor? So maybe I'll start with Mark.
Yeah, so happy to do that. I mean, when we're talking to when we're talking to an entrepreneur, we're really offering them three things: capital, our active team, and that network. And I always say the first one of those, the capital, is the commodity. It's the other two that really move the needle. And so being able to give them access to resources from our team to actually supplement their exec team to help them execute on a growth plan is really, really important. And then being able to give them access to a network who can open doors on the supplier side, the customer side, or just help them scale their business is a really, really big sales part of the sales pitch for us.
And how about you, Roger?
Exactly the same. I usually say the least important thing that I bring is the money. It really is. It's partly the network, obviously, to help, but it's also just the journey. For growing a company, going international. The founders or the team building out the team, how to properly structure option plans, etc. The other thing I've been heavily involved in many, many companies is trying to reassure a customer that they're buying from a startup or early stage company. And quite often I have to get on a call and try to convince them to take that risk of going with an early stage company and the like. And so quite often knowing who's behind the company or who's helping them, who's not guaranteeing it, but you're trying to give some confidence that if they take a risk and buy from a young early stage company, there are some people financially behind it, but also with some expertise and history and good governance on the board, etc.
And you, Wee Ming?
Well, I think the most important factor is about the joint business ownership. I think the family office money are really people from business owner as opposed to institution fund. So, and these are all successful business owners, successful entrepreneur. So we always like to impart that partnering spirit and the way how we look at things, the way how we can participate for joint success, while they still they still stir the boat and they are the captain of the ship, but we are all there behind trying to give our secret recipe away to them, helping them to not reinvent the wheel, but giving them ways that we think we have done it before and share with them openly so that they can also look at the success, that they can appreciate that we are part of their success.
Great. So we've actually sort of run out of time now. So I thought that was a great panel for us to understand sort of the investment trends that family offices are seeing, as well as also how they approach their investments. So thank you, Wee Ming. Thank you, Patrick, Mark, and Roger for your time today.
Ladies and gentlemen, that concludes Emergence 2021. What was meant to be 24-hour has become 24-hour plus marathon is now completed. We have absolutely been around the globe on this one, from incredible insights starting with Australia, New Zealand, then moving over to what's happening in Asia, into India, into MENA, then into the Europe and the UK, and then finishing off in North America and South America. But of course, we had this final session for you that I bet you weren't expecting. Look, I am so grateful that you have joined us for this journey. I hope whether you're watching this live or you're watching this post the event, I hope you've enjoyed the conference. I hope you've enjoyed the people you've had the opportunity to network with. And I hope you've had some great conversations with the companies that are exhibiting at the event. So as a next step, whilst this is the end for the presentation part, what's going to be happening now is over the next week, the platform is still going to be open. Companies have got the opportunity to run their own webinars inside the actual conference. And more than that, you've also got the opportunity to engage for the next week with the exhibitors that have been participating, speakers, attendees, and so forth. So whilst the party stops here from an event perspective, the party continues inside the Brella app when it comes to your networking. So we are not taking the punch bowl away just yet. However, I want to say again, thank you so much for joining us for Emergence 2021. We will see you next year.